Welcome to the European market open, everyone. A minute to go until the start of cash equity trading. Happy Friday, but it's going to be a wild ride today. I'm Francine Lackwin, London, with Tom McKenzie.
Good morning. Here are your top stories. Market sell-off, tech tanks as sentiment sours on stocks. Investors flee to treasuries in a bid to havens. Victims of the sell-off, pandemic stars, Netflix plunges after subscribers disappoint, and Peloton slumps as it cuts production. Plus, line in the sand. President Biden says Russia will pay a heavy price if it moves into Ukraine. Antony Blinken and Sergei Lavrov meet today. We are live in Geneva.
Yeah, let's take a look at the futures, Tom. I mean, I have to say it was a little bit of a bloodbath yesterday. Certainly, it's on the back of those shaky earnings, Netflix and Peloton, and it also brought Walt Disney, which has a streaming service, down with it. So if we're adjusting to the new normal, some of the stocks that have done particularly well may get a beating going forward. But also, cryptocurrencies down, oil's down. There's a massive sell-off which is filtering through to Europe. Yeah,
yen is bid, treasuries are bid. Is that narrative that earnings are going to prove supportive for 2022 starting to fade? It's been mixed, certainly, in terms of what we had out of the banking sector, and then of course Netflix and that disappointment in terms of subscriber numbers. Let's see then how things are playing out as the markets open here in Europe this Friday. The FTSE 100 is down 1%. By the way, consumer sentiment in the UK looking very fragile for the month of December. That will play across and be a concern for policymakers here amid this crunch on households. The BOE, of course, looking to that rate hike. That's the market expectation in February. Just makes it that much more challenging. The Spanish IBEX down 1.5% now. France also down in similar territory, down 100 points in France. So the sell-off is certainly being carried across to what is happening in the European space. It's a little bit more mixed in Asia, more policy support from the officials in China, at least jawboning in terms of lending for banks and the real estate sector. But here the focus is on that run-up in yields and concerns about earnings, risk-off, buying the dip, not coming to the rescue. Let's move in and see how things are playing out cross-asset then as we look ahead to the futures. The focus very much remaining on tech because that's where we saw the most significant volatile action yesterday. Gains of 2% before all of that was wiped off on the Nasdaq 100, which remains in correction territory. Now, futures pointing to lower, further losses down 0.6%. The yield, again, Treasury's yield in this move to havens, as is the Japanese yen, at 177. So down by almost 2.5 basis points. Brent down 1.4%. The inventories in the US ticking up for the first time in about 8 weeks, and then the White House suggesting they may speed up the acceleration of some of their reserves, getting those onto the market. Bitcoin and cryptos really under pressure, down 5%, more than 5%. Ether below $3,000, Bitcoin below $40,000, and that, of course, that alignment between cryptos and tech has really come into focus in the last few weeks. Fran?
Yeah, I was looking at some numbers actually on cryptocurrency overall, so the cryptocurrency market, so you take all of them, they lost some $1 trillion since that November peak. So actually that's quite a significant amount in that asset class that's been lost. All right, look at that. We have a lot of red, the sell-off, maybe some of the consumer stocks, just one, I believe in Europe is not doing too badly. Otherwise, it's basic resources leading the losses, down some 3%, travel and leisure, the next worst performing sector. John, I have to say, what's worrying investors is, of course, I think a bit of geopolitics is also in there. We have Sergei Lavrov speaking with Antony Blinken, and then it's the Fed. We've been talking about the Fed moves, and then look, if you start having those shaky numbers from Peloton, and if you have the same for Netflix, they had the slowest start to the year in 10 years, then you wonder whether you need to reprice because actually we could be moving from pandemic to endemic, and so we consume things differently.
Yeah, is that work from home theme now dead in the water given what we've seen from the likes of Netflix and Peloton. In terms of the earnings picture, we've said it's mixed, and we had an update from Siemens Energy. On one level, you'd thought this would be a company benefiting from the shift to renewables, but oh no, supply chains and margins. And they have downgraded their forecast for the full year, saying they may see a drop in revenue of 2%. That stock now down more than 5%. Bernstein coming out and saying this is essentially uninvestable. Royal Dutch Shell under pressure by 0.5%. That's about the broader oil story. We talked about that in terms of inventories and the White House comments on releasing additional reserves. And Argo blockchain listed here in London. I picked this one out because, of course, we want to see how it reflected given the sell-off in crypto. Down almost 10%. They have Bitcoin mining assets in Canada. Again, just the pain point for crypto as we go to risk off. Let's get the Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Good morning, Tom. And as you mentioned, Netflix shares have plunged as much as 20% in extended trade after forecasting weaker subscriber growth than expected. The streaming giant says it expects to add just 2.5 million customers in the current quarter, blaming a tough economy and lingering fallout from the pandemic. Wall Street was looking for 6.3 million new subscribers over the period. Now, Russia's central bank has proposed a blanket ban on the use and creation of all cryptocurrencies. The country is one of the biggest crypto mining nations in the world. Officials say digital tokens bear the hallmark of a pyramid scheme and undermine the sovereignty of monetary policy. Russia already bans the use of cryptos to make payments. Serbia has blocked Rio Tinto's plans for Europe's biggest lithium mine. The Prime Minister says she is halting the planned $2.4 billion JDAR project, which has become a big environmental issue ahead of Serbia's general election. The decision is a blow to Rio's new CEO, who approved the project as one of his first big decisions. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. So much going on in the world of markets, but also in the world of business. And often the two are disconnected. Today, not so. Well, joining us now to talk about the markets and some of the big business stories, Leanne was also just bringing to us Richard Dunbar, Investment Director and Fund Manager at Standard Life Investments, and our very own Bloomberg Markets Editor, Christine Aquino. So thank you both. It's an exciting, sometimes worrying. I don't know how many traders will go and hide behind their desk, Christine, to try and make sure that they don't catch any of the falling stocks. But is this, I mean, this is a bit of everything, right? It's a little bit of concern on geopolitics. It's, of course, worrying about what the Fed will do. But then there's also these shaking earnings, which points to a different economy that we could see in the next couple of months.
Absolutely, Francine. And it's really quite fascinating because you could see the shift in the catalysts and what's driving markets. You know, earlier this week, we've all been talking about the great big bond sell-off driving everything else. Now, the catalysts have shifted. It's very clearly these negative earnings reports overnight and the fallout for the tech sector really flowing through to everything else. And it's the shift in that reaction function tells you what the market's anxieties are currently and how that's kind of playing through to markets. It is very much this idea now of, you know, going into this new era, post-pandemic era, potentially. What does that look like? And which ones are going to be the winners? Which ones are going to be the losers? I think we got a clearer picture of that yesterday from Netflix and Peloton.
Okay, Richard Dunbar, let's bring you in at this point. Happy Friday. Thank you for joining. We'll get onto yields, we'll get onto the macro, go onto the Fed. But when it comes to earnings, and we just want to dial into this, the Netflix and Peloton stories, to what extent are they idiosyncratic? To what extent do they spell the end of that work from home theme? To what extent should they be read across to the broader tech sector when we look to Apple and others who are going to be reporting in the next few weeks?
Well, we will be looking at that carefully, as you would expect. As Christine notes, so this is not just about a slightly rising discount rate, a rising bond yield, and discounting future earnings. This is a miss on earnings from Netflix to 2.5 million subscribers, 4 to 6 million expected, and expecting to see that continue rather weaker. Although it's interesting, this time, or in the middle of last year, when we were expecting to come out of the pandemic, there was fears that Netflix would have been a stay-at-home stock. And actually, it continued to deliver even as we started becoming or getting back to more normality. So it'll be interesting to see over the next few quarters whether that actually comes to pass or whether this is a change in behavior and this stock becomes something of the past rather than something of the future.
Yeah.
But
Rich. Yeah, Richard, sorry, I'm jumping in because it really reminds me of early 2000 when I think even Goldman Sachs wanted to be called GoldmanSachs.com. I mean, everything's now a tech stock, right? I don't know whether Netflix is as you say, a stay-at-home stock, and Peloton is a stay-at-home stock. And so actually we need to really make a difference between the big, the Apples, the Googles of this world. By the way, there's also a bill that happened in the US that will be much tougher on them, and the stay-at-home, and whether at the moment investors may confuse them.
Yeah, although that said, when you look at something like Netflix, we describe it as a stay-at-home stock, but it's been one of the most successful stocks over the past decade when we weren't staying at home. So it has delivered in those sorts of environments. It's also delivering, despite lower than expected profits and cash flows, it's still delivering significant profits and cash flows, and that sets it aside, from something like Peloton at the moment, which is not. So I suppose it's a lesson for all of us to do one's homework, to make sure you know what profits and cash flow to expect, and discount those at the appropriate levels. But I think that Netflix is still delivering, although it's a difficult market. They note a stronger dollar over the period. They note more competition, and they note weaker economies in some of the areas they're doing their business. These are normal things that analysts should be looking at, and as I say, not tied into a discount rate or a swing from growth to value, I suspect.
Yeah, certainly we saw the pressure on Disney as well on the back of those Netflix results. Whether Netflix can carve out some opportunities in places like India, South Korea, and Japan as well, maybe that comes to the rescue a bit in terms of subscriber numbers. Christine, let's take it back to the broader picture around what's happening in the equity markets. Has buy the dip now just totally faded for 2022? It seems like it's sell into the rally seems to have been a theme, certainly, that fed through yesterday.
Absolutely, Tom. And I think that is very much the shift that we're seeing this year. Even last year, toward the end of 2021, we were already starting to see cracks in this sort of buy the dip strategy. And yesterday's move was really a great example of this idea that maybe we're past the buy the dip era. This sort of drawdown is very, very rare. When we see stocks potentially seeing a bit of a gain into the day and then completely vanishing. That's only happened once last year, maybe a couple of times in 2019. And this is more akin to what we were seeing in the 2020 era when the world was still grappling with the uncertainties of the height of the pandemic. And so that really tells you, there is a bit of a shift here. I think sell the rally is the best way probably to describe it at this point, especially with these sectors here.
Yeah, so Richard, why are the markets so nervous? I know there's geopolitics, there's of course the Fed worries, and then there's these shaky earnings. But is there something else that we should be looking at?
Well, I think it's a combination of many things, Francine. We're entering this year with economists downgrading their growth expectations. We're still expecting a couple of years of above trend growth, but it's a lot lower than we had expected 3 or 4 months ago. So that's a headwind to corporate earnings. We're nervous on the inflation. We're still seeing those inflation numbers ticking in higher than anyone had expected 3 or 4 months ago. Again, including most importantly central banks. You touched on geopolitics. There's a long list of things one could worry about, and also go back to Christine's point. We entered the year with valuations in our mind fair, but certainly not cheap valuations. So we're not being protected by cheaper valuations or by upgraded earnings expectations, which give us a lot of cover when we were speaking a year ago.
Okay, some of that cover starting to fade for 2022. Richard Dunbar's going to stay with us. After the break, we'll get some of his calls. Christina Kino from Bloomberg breaking down some of the key market themes. Thank you. Okay, coming up, things, as we've been discussing, not so chill over at Netflix. The streaming giant plunges after its outlook for subscribers disappoints. We're going to break down what happened with Netflix and what it means for the broader tech sector next. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. why not use the tests strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is affected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Back to the open, everyone. I was going to say TGIF, but actually, given the sell-off that could be just starting after the shaky earnings from Peloton and Netflix, but also the concerns on geopolitics around the world. And then we have the Fed. We've been talking about the Fed nonstop and whether they raise rates more than expected. You can see European stocks under pressure with the DAX down 1.4, similar losses across the board. And we're just at the beginning, so we're not exactly sure whether U.S. investors, like in the past, come in and buy the dip or whether we accelerate those losses.
Yeah, so far it seems they've been standing on the sidelines. But as we were discussing the top half, Netflix and the earnings there, certainly the disappointment around subscriptions, firmly in focus as well, sending shudders through the markets yesterday. Shares of Netflix falling sharply in late trading after coming up short of subscriber estimates for the fourth quarter. The streaming giant forecasts it will add just 2.5 million subscribers in the current quarter. That is way below expectations. And shares of another high-profile company, Peloton, may have heard of them, plunged. That was after a report that it's temporarily stopping production of its connected fitness products, including its signature bike, due to a drop in consumer demand. Joining us now is Bloomberg Quick Take correspondent Alex Webb, and still with us, we're pleased to say, is Richard Dunbar, head of multi-asset research at Aberdeen. Alex, talk us through what we heard then from Netflix and Peloton and why there was such a sharp reaction from markets for what on some level would seem pretty obvious. They did so well, Netflix, in 2020, as did Peloton. There was always going to be some take back.
There'd been some optimism around Netflix because, of course, the problem they'd had over lockdowns was they weren't able to produce as much. They weren't able to make as many shows, as many films. Therefore, there's been, since the autumn, a sort of deluge of content dropping from Netflix. There was some sort of expectation then that that would reignite subscriber growth in a more organic basis, not the one that's just driven by the lockdowns. This has shown that's not really been the case, and certainly not to the extent that people had hoped. Peloton, the report came from CNBC that they had stopped all production. There was a little bit of pushback on that. I think in both cases, probably what we're seeing is that the demand that's there for this product is there, and it was just brought forward quite a lot.
Alex, what surprised me, 2.5 million new subscribers is actually not that bad. I don't know whether it's Wall Street expecting too much from Netflix, so looking at their models and modeling on something that's just unsustainable, or whether there's a real concern that maybe there are also too many streaming services.
It's partly too many streaming services. Also, like, if you look at the home market, they can't, probably quite saturated already in terms of where Netflix is. Is it going to be
them all.
Well, I mean, I'm embarrassed to admit I've got all the US ones and the UK ones, and I've got Canal Plus everything. But growth is really looking to Asia and stuff like that. So when we think about Squid Game, that was a big hit internationally, but also can it drive more subscriptions in Asia? They are upping investment in Asian content. That is something that perhaps is a glimmer of hope looking forward.
Okay, Richard, look, we touched on this, but it's such an important story in terms of the trends around technology. Is this an opportunity, and again, Fran kind of alluded to this in her question, but do you buy mega cap tech on the back of a knee-jerk reaction in terms of the sell-off in tech, or is there something more fundamental at play?
Well, there's probably a little of both, to be honest, Tom. When you look at what Netflix are actually saying last night, they're talking about worries about particularly the Latin American economy. They were talking about worries about a strong dollar and the translation impact. They were talking about the competition, as you've just touched on, from Disney and others, and the cost of content. But also they were setting out what is a content offering second to none. So a lot of those things are the normal things that one should look at in terms of determining whether a stock is good, bad, or different. The revenues, the margins, and the earnings impact of what one pays for that. So it wasn't so much the discount rate or the move from value to growth to value. So I think a lot of what they were saying would talk to just doing one's homework a little bit more. You're having a look at the forecasts, and it's not so much work from home, not work from home. It's what the sort of medium to long term implications or what prospects of this company look like.
Richard, everyone's really, thinking about the fact that Alex has HBO Max and Canal Plus, and everyone's really envious. I only have the Italian channels, where are really close to useless. I mean, there's not even any politics news on there. Richard, when you look at, what the analysts are doing, and this morning they're really trying to play catch up, especially with Netflix. I think we had 4 downgrades since this morning. Again, are we just too optimistic? Are analysts too optimistic? And how do you do that, or try and do that differently at Aberdeen?
Well, they obviously have been too optimistic. Netflix obviously missed for the quarter just past, but they're warning for the quarter and probably quarters ahead, and they're talking about increased cost of production and concerns in currency and the broader slowing economy, and particularly in some of the higher growth areas of their world. So it's actually just having a look at it again. Looking at the expectation, looking at the robustness of those expectations and the risks around those expectations. But as I said, we have been here before, and Netflix is not just a work from home. It has been a work from home beneficiary, but it's not just a work from home stock. It's prospered in different environments, and I suspect will continue to do so.
Okay, Richard, I just want to tease out one of your views on emerging markets, because there is maybe a point where EM starts to get a bit of a bid in 2022 if you get a softer dollar, if central banks in that part of the world have been ahead of the Fed, if China starts to support with more stimulus. Are you looking for opportunities in EM?
Well, we always are looking for opportunities in EM as an asset class, and in particular areas within it. And I agree with all the comments you make. A slightly weaker dollar is generally helpful. EM central banks have been ahead of the curve, and it's only now we're realizing how much ahead of the curve they have been, when we see how behind the curve some of the developed world central banks have been, particularly the Fed. So that gives an opportunity for central banks in emerging markets. And obviously within that, there's been some sort of idiosyncratic weakness in some of the emerging markets, particularly China and some of the Latin American markets. So that there looks like there's opportunity there. Going back to our earlier conversation, there's better value in many areas of the emerging market complex, and that certainly gives you protection in some of these more volatile environments.
Richard, thank you so much. So interesting. Richard Dunbar, their head of multi-asset research at Aberdeen, and also our Bloomberg Quick Take correspondent, Alex Webb. What's the best thing you've seen on TV? You have all these channels. A Wordle man?
Station 11.
Okay.
HBO Max coming to UK. It's incredible.
Okay, Call My Agent.
Never heard of it. It's Call My Agent. Succession.
Boom.
I mean, middle of the third
Station 11,
series.
best thing I've seen since Breaking Bad.
Fantastic. The acting, the humour.
We'll discuss it on social media. Coming up, CVC has lined up banks for a potential IPO that could value it at over $20 billion. That story up next. This is Bloomberg.
big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Welcome back to the Open. Happy Friday. We are 24 minutes into the European trading day. Losses of 1.5% across the benchmark European Stock 600. Futures in the US, the Nasdaq futures pointing lower by 0.7. The S&P E-minis down by 0.4. Your sectors at the bottom of the list, basic resources and autos, everything is in the red this morning.
Now, one of the oldest names in European private equity, CVC, is lining up JP Morgan, Morgan Stanley, and Goldman Sachs for a potential IPO. The listing could see the firm valued at over $20 billion. Well, joining us now to discuss the potential listing is our very own Danny Berger. So, Danny, first of all, I mean, it's amazing the number of companies in private equity that have done this in the past. Are they a little bit too late to the party?
Well, if you want to kind of be the Blackstone, the KKR, they've gone public a while ago. So in that regard, definitely. And CVC kind of is the European equivalent to that, right? That is our region's private equity giant. So if you want to be like the big players, I mean, maybe it makes sense to go public. And they can look at the success of TPG last week. EQT here in Europe, which is, of course, smaller than CVC, they went public in 2019. They've done well as public companies. It brings in more money, brings in more investors. So at this point, why not join the party?
Danny, I thought SPACs were a sign of bubbles, but we've got another one, KKR. And it's not just your regular SPAC. I don't know if there is a regular SPAC, but it's all about pets and pampered pooches. What's going on?
Yeah, I feel like pets doesn't necessarily make people feel calm. If we're talking about bubbles, pets.com comes to mind. But of course, this is very different. This is
no flashbacks there.
Now, you guys won't know this, but in the US, if you drive around, you have to get your pet something, you go to PetSmart. I don't think they exist here, but it is a very well-known chain. It is owned currently by another private equity company. And so KKR reportedly is in talks to acquire them through a SPAC. Now, not only is it a SPAC, a kind of, something that has cooled off a bit, it's also a big one, $14 billion. It's also pets, a sector that has exploded during the pandemic. A really interesting play here because a lot of pet-type companies, valuations are really high, so KKR must just believe that it can do even better as a public company.
I mean, I'm here only for the pet finance conversation. Also, I recently, as everybody on this earth knows, got a pet, which I'm obsessed with, and when you look at the prices, I was like, I'm going to get for the cheaper one. And then, of course, there's always one girlfriend that says, why would you not give it the best you can? So I think these valuations are perfectly fine.
I have to say, one of my favorite quotes was from the CEO of Pets at Home, which is a UK company, who likened the pet boom to the post-war baby boom. So that's where we are now.
The people are having more pets, not making more pets. Danny Berger, save me, joining us, of course, on SPACs. Now, coming up, we talk the future of China tech. That's coming up shortly. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. It's a market day. Market sell-off, tech tanks, sentiment sours on stocks overall. Investors flee to treasuries in a bid to havens. Victims of the sell-off, pandemic stars. Well, Netflix plunges after subscribers disappoint, and Peloton slumps as it cuts production. Plus, line in the sand, while President Biden says Russia will pay a heavy price if it moves into Ukraine. Anthony Blinken and Sergei Lavrov meet today, and we're live in Geneva. Tom, it's actually quite an acute sell-off, and I think it's been accelerating a little bit. And again, it's geopolitics, it's what the Fed does in terms of interest rates, and now there's these, shaky earnings from Peloton and other companies.
Yeah, as we were discussing with Richard there from Aberdeen, it's that whole mixture of elements that you're discussing as well. The higher yields, that move around inflation, what is happening around tech, and the concern that maybe buy the dip is starting to fade, work from home, certainly earnings mixed. And then the geopolitics of Biden having to come out and draw that red line when it comes to the commitment from the US and allies to punish Russia if indeed they do move troops into Ukraine. In terms of how things are playing out then, losses of 1.5% across your benchmark. The DAX is lower by exactly the same amount. Similar picture on the CAC Cajon. UK consumer sentiment very weak for December, coming in much below estimates, suggesting there is a challenge there for the UK economy as we lead up to February and that BOE decision. Let's move it on, see how things are breaking out sector by sector. We have the oil story as well playing out. The news that in terms of inventories, they came in higher than they have done for a number of weeks stateside, and also the White House suggesting that maybe they will step out the release of reserves. They, of course, want to pull inflation down. That is a key policy now for the Biden administration. They are feeling that pressure at the polls. They want to get oil prices down. That is having an effect certainly today. Across your sectors then, right at the bottom of the list, basic resources, followed by travel and leisure, auto parts as well. Every single sector in the red this Friday. Do investors start to take a step back and think maybe they can get in? Are there opportunities here, or is there just too many risks, Fran, as we navigate the challenges of inflation, geopolitics, and this rotation out of tech?
Yeah, I was thinking we don't actually have that many technology streaming services in Europe, and maybe that's a good thing, but it doesn't really help with that sell-off. And it's also influencing everything. It's actually hitting cryptocurrencies across the board and a lot of things that we thought would have been a haven.
Yeah, it's been really interesting to see that alignment with crypto and tech, particularly in the last few weeks. So as crypto sells off, so does tech. Or as tech sells off, so does crypto. So much for the crypto hedge there. Let's switch focus to a nation that used to be the beating heart of all things crypto, long gone because of regulatory changes, but broader regulatory impacts in China. The curb, of course, on the influence of these tech companies and the rooting out of corruption tied to disorderly, that's how officials are putting it, expansion of capital, signaling an expansion of their regulatory crackdown, which has erased more than $1 trillion of market value last year. Joining us today from Beijing is Kendra Schaefer, tech partner at Trivium China, someone who really goes through the weeds, really monitors the policy changes, the data changes, and how things are shaping up in terms of that evolving regulatory environment in China and the importance of that. Kendra, where are we in this shift, and what have we learned from officials about the forward play for these rule changes when it comes to technology?
Hi, Tom. Well, never a dull moment in China tech policy. As you know, 2021 was fast and furious for China's tech companies. They got fire hosed with regulations from data security to anti-monopoly, overseas listings, online content, games, you name it. And so investors are still reeling from those reform efforts that Beijing's undertaken. So, of course, the key question is, where do we go now? Luckily, we may have some clues. 2 days ago, China's NDRC released a regulatory to-do list for the platform economy, a kind of blueprint for what Beijing expects to see from its tech sector and where tech regulation is going. Number one, anti-monopoly push is not going anywhere. China's anti-monopoly and fair competition drives are here to stay for 2022. They will intensify. All signals are pointing that way. But so far, no breakups have been ordered, just fines. So what we're looking at this year is we expect regulators to review the 2016 Didi and Uber merger, and we'll see what comes out of that, whether it's just fines or what Beijing decides to do. We're also looking at another big round of regulation for the fintech sector, according to this document. So particularly non-bank payment platforms like Alipay and WeChat. Specifically, regulators are looking to disconnect what they're calling improper ties between payment instruments and other financial products like lending apps or lending products. So that's really what we're looking at going forward.
Okay, there's a lot to unpack there, Kendra. You talked about the Uber and Didi deal, which is fascinating because Didi, of course, vanquished Uber in their home market and then have felt and of course, faced up to a barrage of regulatory changes that have impacted that company. Of course, the listing as well impacted. What does it mean? We had some reports as well out of Reuters suggesting that China and officials are going to take a closer look at investments of these companies. They're going to have to get those approved. Do we have any clarity on that and what the implications are?
Yeah, so there's a couple of things going on here, Tom. Number one is that SAMR, the State Administration of Market Regulation, which is responsible for M&As and reviewing M&As, is going back under this anti-monopoly drive and reviewing every single M&A, even the little ones, that have kind of gone through under the radar over the last 4 years. One of the M&As possibly under review is the Didi Uber merger, but there's nothing to break up at this point. I mean, they can't really, Uber China no longer exists, as you say. So we expect that there will be some probably pretty big fines leveraged, and then some restrictions put on where Didi is allowed to expand and where it's not allowed to expand in terms of future acquisitions. In terms of, yes.
Kendra, I mean, if you look at the communique that the Communist Party put out, I mean, it was pretty sweeping, right? And basically what they want to do is break the ties between money and power. I mean, after the onslaught of regulation that we had in China last year, like really, unless they break up these companies, what more can they do?
Well, ultimately what they're doing is putting couple of things. One, putting bounding boxes around what those companies are allowed to do and how they're allowed to behave in the market. So it's really strict corporate behavior controls rather than simply cutting them off at the wallet. One of the most interesting policy shifts in Beijing most recently is that it's very clear Beijing expects platform companies to invest heavily going forward in hard tech R&D. They want platforms to put money into foundational scientific research in areas like, semiconductors, AI, next generation manufacturing, smart agriculture. The idea here being that platforms have, an incredible amount of wealth and power. As you said, they have talent. They shouldn't be using those resources to disrupt pizza delivery, right? Or optimize bicycles, right? What they should be doing is helping China meet its national strategic goals.
So Kendra, can they do that? Can they ring fence the behavior of these companies? Can they pressure them to follow the strategic policy goals of Beijing whilst avoiding killing the goose that lays the golden egg? What has the evidence of the last 12 to 24 months told us about that?
That's a very good question. In fact, we don't really have a good view on what the result of all of this crackdown has been, again, except for looking at how much money has been wiped off the books. Over the long term, Beijing is really not thinking in terms of, investment cycles, 1 year, 2 year, 3 year returns. Beijing is thinking about laying the foundations of its tech sector over the next 10, 20, 30 years. When you don't have an election cycle here, right, you don't have to worry about, one administration going out and the next administration not following along with the past administration's policies. So Beijing is really setting down some frameworks that are going to last here for the next several decades. So this is a wait and see game, I think.
Okay, Kendra Schaefer, great analysis, as ever, tech partner at Trivium China, on the outlook for these regulatory changes. This blueprint that was published by the NDRC over in China on the potential implications for that sector, Fran.
Yeah, I was quite impressed by some of the translations saying, the Communist Party in China saying they'll have no mercy for businesses. That, as an investor, must send chills down your spine. Bank earnings in focus. We discuss soaring Wall Street compensation costs and look ahead to European bank earnings. And then coming up a little bit later, it's murky. We have a great story actually calling the elections of the president in Italy very papal. We'll be speaking to Matteo Renzi, the former Italian prime minister and leader of the Italia Viva party. We'll get his views ahead of the election that starts. Voting starts on Monday, but actually we really don't know what will happen. So it's an interesting one for the markets. This is Bloomberg.
EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
You have to be competitive. You have to pay people. We don't want people want to work for less next year.
We will be competitive in pay. If that squeezes margins a little bit for shareholders, so be it.
On compensation, our philosophy remains to pay for performance, and we are committed to rewarding top talent in a competitive labor environment.
Well, Brian Moynihan, Jamie Dimon, and Dennis Coleman discussing Wall Street's soaring compensation costs. Now, to talk about the banks and the big Wall Street names, of course, posted results this week. Next week, it's Europe's turns. We're joined by Octavio Morenzi, Chief Executive Officer of Appimas. Octavio, thank you for joining us. I mean, there's a million questions on if the U.S. banks are coming under pressure for costs. Does it mean that Europe will suffer even more? Or actually, will we be left off lightly because we don't pay bankers as much?
Well, I think it's going to be more the latter than the former in Europe. So I don't think we'll see the same kind of wage inflation that you saw in the US bank earnings. But I would point out it wasn't uniform across the US banks in terms of seeing that. So there were certain banks that seemed to be spared that. So if you look at Morgan Stanley, their compensation costs didn't go up nearly as much as Goldman Sachs did and were under much, much tighter control. You saw Citigroup's compensation go up really substantially, but Wells Fargo actually went down a bit, despite, I mean, that was sort of hidden by the fact that they had reduced their headcount a bit, but still we saw compensation costs go down there even faster. So it's not uniform across the US banking sector. So I don't think it's fair to say that universally across the US banking sector, earnings and wages went up. That's far from the truth. So I think in Europe we won't see the same kind of wage inflation. It'll be much, much softer.
Does it suggest that the wage inflation we have seen in US banks is a temporary phenomenon then, Octavio, or is it going to be more pronounced, more long term?
I think in the US it's going to be pronounced and long term. I don't see the Fed getting general inflation under control anytime soon. They're talking about very, very tepid interest rate increases. They're saying they're going to raise interest rates maybe 3 or 4 times this year, which might take them up to about 1%. So moving the base interest rate from 0.25% up to 1% is not really going to get inflation under control. So we're going to see wage inflation, but bear in mind wage inflation is not sort of uniformly distributed through the economy. There's certain sectors that see much more wage inflation, certain sectors see far less. Investment bankers and traders and those kinds of people are seeing a very substantial amount of wage inflation. So it's not a uniform distribution throughout the industry and the economy.
Octavio, overall, for example, you look at some of the prices that they pay bankers at JP Morgan, it still makes business sense. If you get the best of the best, then you'll reap the rewards in a couple of years. Otherwise, they change shop.
Definitely. I'm not saying it's a strategy that doesn't make sense, and to a certain extent you're forced into it. But it is interesting to note that some banks didn't pursue that strategy and did quite well. So Goldman Sachs' stock got whacked as a result of these spiraling wage costs that they have. And someone like Morgan Stanley did actually very, very well, who had much more limited increases. So it's not right through every bank seeing that. So not every bank is pursuing the same strategy. And I agree, Jamie Dimon was on just now saying that they're going to pay people what they have to pay them to get good talent, and that's absolutely the right thing to do. However, some banks seem to be getting away with not doing that. So that's an interesting thing to watch out for and see how that evolves. But I expect wage inflation to continue to actually accelerate a bit into 2022 in the banking sector, and we'll see how the Fed responds. At some stage, the Fed is going to have to put on the brakes. That being said, it's also going to be, I think, much more difficult in the coming year, particularly in trading, in equities trading and fixed income trading, to actually be highly profitable. So I think those lines of business are going to come under pressure. I think investment banking, we still see a big backlog of deals into the first quarter, but that seems to be slowing down as well. So there's going to be far less debt underwriting as interest rates increase. And on the equity side, as equities markets come to pressure, there's going to be fewer companies that want to go public. So I think the investment banking side will come to pressure as well, and wages will then become controlled as a result of that directly.
What about loan growth? Is that starting to pick up for this year?
That's very uneven. So if you look at some banks like JP Morgan, has very, very tepid loan growth. Bank of America had fairly strong, still single digits. I think Bank of America's loan growth was about 6-7% over the course of the past year. So that's a more encouraging sign. But certain bankers, depending on their portfolio of lending, saw loan growth actually go down a bit as well. So if you look at home lending with increasing interest rates, the home lending business is suffering really badly. There's far less mortgage origination and far less refinancings taking place, or absolutely no refinancing taking place. So that lending portfolio depends. So it depends on what your mixture of loan portfolios is. Credit cards seems to be doing well, so that's a loan portfolio that's gone up. Housing down. So it's mixed. It depends on the bank's individual mix and exposure, their portfolio of loans.
Octavio, overall, there's been an assumption in the last couple of years because of, tax, because of a number of things, including interest rates, that actually it's easier to be a bank and make more money in a bank than it is in the U.S. rather than in Europe. Who's best in class in Europe, and are we going to see cross-border M&A activity?
I think cross-border M&A activity, I think the regulators aren't quite ready for that yet. So I think they've basically put a brake on cross-merger or large bank mergers some years ago, and I don't think the regulators are about to revisit that. At some stage we will. But I think the firms that the banks we're going to see do really well are going to be the ones that have strong exposure to things like wealth management, asset management, and those things have not been hit as hard at all. So I would expect the Swiss banks, UBS, Credit Suisse, to do quite well out of that. as those units and business lines do well and have continued to do well. And the more exposed you are to sort of the bread and butter lending, corporate lending, consumer lending, the more sort of flat your earnings and revenues cycle is going to be. And the more exposed then you're to investment banking and trading in particular, the more difficult things will start to become in 2022. So investment banking, I still think, is going to be really strong for European banks. Certainly we saw the US banks having a very, very strong quarter there. Trading, not so much so.
Right.
So there's that mix that's changing.
Okay, Octavio Marenzi, CEO at Optimus. Thank you for taking us through some of the key themes from the US earnings, giving us a preview for the European earnings for banks.
Yeah, he really does have the best name in business, Octavio. Now, coming up, efforts to avert a military conflict in Ukraine continue with the US and Russia's top diplomats now set to hold crunch talks in Geneva. We also had a warning from the US and Germany earlier this morning. We have that story next, and this is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Happy Friday. Welcome back to the Open. We are 51 minutes into your European trading day. Pronounced is the sell-off that we're seeing across equities. The European stock 600 lower by 1.5%. Every single sector in the red. Basic resources down by 3%. Autos down by 2.7%. Treasuries are bid. The yen is bid. Crypto and the sell-off there, 39,000 for your Bitcoin, down more than 5%. Talking of Bitcoin,
crypto.
Bercow, John Bercow, former Speaker of the Houses of Parliament, calling for order. I can't quite do it, but he has this amazing baritone voice, doesn't he?
Yeah, so I was flicking through Twitter, and I have to stop that because it was way too late and I had to get to bed. And then suddenly, there's a 45-second video of John Bercow on Twitter, and it was tweeted by a crypto company. And so, you know, all the journalists on Twitter are kind of alight with what's happening. It's the end of the world, like a meteorite's going to strike. And then so I tweeted at the company saying, like, sorry, what is this? And then I was explained by the younger folk in the newsroom that there's something called Cameo. So you can go out, it's cameo.com, and this is really the only thing I want for my birthday next year. And you can basically get personalities such as John Bercow. Now, this is wrong or not. We don't judge. but you can basically pay them, up to £2,000, and they give you like a 40-second, you write the script, I think, and they just read it out.
So it's a nice little earner. Who would you want to call up, though, for your birthday?
Probably Poirot.
Poirot. I think we should get you on there, Fran.
I'm not sure, but I just find it amazing. And then it goes back to, some of the controversies that we've seen often with UK politicians.
Oh, yes.
Fee earnings after they've been downing.
Oh, yes. Order. Okay, John Burkout there. All things Twitter and calling up celebs for your birthday. Let's make a note of that one for when Fran's big day comes around. Let's switch focus to geopolitics, slightly more serious events then. And Ukraine. Efforts to avert a military conflict in the country continue, with US Secretary of State Antony Blinken set to meet his Russian counterpart Sergei Lavrov in Geneva. Here is what political leaders have been saying about the crisis.
My guess is he will move in. He has to do something.
In these kind of circumstances, we have to be ready for everything.
If Moscow chooses the path of further aggression, we will impose swift and massive costs.
The Russian side is aware of our determination. I hope they also realize that the gains of cooperation outweigh the price of further confrontation.
Any use of force against Ukraine will be a severe and serious strategic mistake by Russia, and it will have severe consequences, and Russia will have to pay a high price.
It is going to be a disaster for Russia if they further invade Ukraine.
We don't threaten anybody with anything, but we do hear the threats addressed to us.
Okay, Bloomberg's Europe correspondent Maria Tadeo is on the ground in Geneva. Maria, the US saying there is still a diplomatic route. If there is one, what is it?
Well, it's very unclear, and I wish I had the answer for that question. But, of course, we know that there's a meeting between Antony Blinken and Sergei Lavrov that will happen in about 2 hours. The idea here that keeps being repeated by the U.S. administration is that Russia has to de-escalate, and then there will be a diplomatic path forward. It is interesting, however, that overnight we had a number of documents from the U.S. government saying we want to make it very clear here in the situation, Russia is the aggressor. Ukraine is just trying to survive. And they also say Russia has been engaging in major disinformation over the past few weeks when it comes to Ukraine. Now, of course, when you look at what is happening here, this is a very tricky situation. It's at a deadlock. But essentially what you have right now is Russia saying we want something on paper that tells us and guarantees that Ukraine will never join NATO. We know that the West is not going to concede on that. And of course, when you look at the demands that are being put forward by Western allies, they want to see those troops being pulled back. The problem for Vladimir Putin, of course, is that that would look like a defeat. So the way forward here looks very unclear. And I have to say, speaking to some of the Russian press here, Francine, it's always interesting to see their perspective. And they say they're not expecting a lot out of this.
Yeah, and Maria, I wonder whether the real question is whether the West just bundled it up, because Putin does not feel threatened by NATO and it does not feel threatened by the West.
Yeah, and that could be one of the issues here, that at this point he believes that the United States is not going to go to war over Ukraine. The Europeans are not ready to do that. They have an energy crisis that is happening at this point. The Nord Stream pipeline is still very much weighing into all of this. And of course, we know that European security is still very early days. When it comes to NATO, you could also argue they're not going to go into a major war when it comes to Russia. The battle here is being played on the economic front. And that is essentially the question that Vladimir Putin will have to answer. Is he willing to take the economic pain of sanctions to get a political win or not?
Okay, Maria today on the ground in Geneva. Thank you. Coming up in the next hour, we're going to speak to Matteo Renzi, the former Prime Minister of Italy, of course, and the leader of Italia Viva Party. Plenty more coming up. This is...
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Any assembled Russian units move across the Ukrainian border, that is an invasion. But it will be met with severe and coordinated economic response that I've discussed in detail with our allies, as well as laid out very clearly for President Putin.
We're trying to pinpoint what that is. It's tough to say exactly why our acquisition hasn't, kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang.
You have to be competitive. You have to pay people. We don't want people want to work for less next year.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Market sell-off, tech tanks as sentiment sours on stocks overall. Investors flee to treasuries in a bid to havens. Victims of the sell-off, well, pandemic stars, well, Netflix plunges after subscribers disappoint and Peloton slumps as it cuts production levels. Plus, line in the sand, President Biden says Russia will pay a heavy price if it moves into Ukraine. Antony Blinken and Sergei Lavrov meet today, and we're live in Geneva. Now, first thing is first, let's check in on the markets. We actually started the day on a real downside. A lot of these European stocks down some 1.5%. They are still seeing similar losses. Now, there are three things that they're worrying about. First of all, it's Fed readjustment to policy. We've been talking about it, but it's really coming at the forefront with some of the figures out of the U.S. Second, it's these shaking earnings, not only Peloton, but of course Netflix. Yes, they added 2.5 million subscribers, but it's well below what Wall Street analysts were expecting. And even Bitcoin had taken a hit, you can see below that 40,000. And the third thing they worry about is, of course, what's going on in geopolitics with a possible, once again, invasion of Ukraine with Russia. We have Sergei Lavrov and Antony Blinken in Geneva, but it doesn't look like we're going to get much progress. Look out for dollar 172 or 1,172. That's a Bloomberg US dollar spot. Now, overall in Europe, we did see on the back of that Peloton and also Netflix story, a lot of streaming services taking a hit. We don't have that many in Europe, but it's the stay-at-home stocks that are also at the margin getting repriced. Then we look at Italian politics with Matteo Renzi. That's coming up a little bit later as we start, of course, the voting on the president on Monday. The FTSE MIB down some 1.4%. So the COVID-19 pandemic is not over yet, but the boom it helped create for stay-at-home stocks appears to be vanishing. Yes, Netflix and Peloton, two of the highest profile stars of the lockdown era, both saw shares sink, the latest sign that investors have moved on from the so-called pandemic trade. Netflix expects to add a paltry 2.5 million users in the current quarter, well short of estimates, and the company's CFO blamed the pandemic on the earnings call.
we're trying to pinpoint what that is. It's tough to say exactly why our acquisition hasn't, kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang.
Peloton, meanwhile, is slashing costs to cope with slowing demand for its stationary bikes. Well, joining us to talk more about the markets, our markets editor, Christine Aquino. Christine, I guess the concern is that there are a number of factors. So you have geopolitics, you have the Fed, and then you have concerns about earnings going forward. I mean, what will markets latch on to today?
Well, Francine, I think it is very much the bad news from the tech sector that we saw overnight, driving everything else overwhelmingly. I think you can really see it from just the way that the stocks in Europe have reacted to this as well. We're definitely seeing that read across from the tech sector. And of course, everything, your havens today, your bond yields, your treasury yields are down. And of course, dollar yen also following that trend lower. And I think, yeah, it really is a marked shift in the catalyst, because we started this week worrying about the great big bond sell-off and rate hikes, and we're ending the week worrying about Netflix and Peloton.
Yeah, but so if we're less at home, it means we go and spend more in restaurants. So I don't understand. I mean, there's not really anything being bought right now. Is the market kind of, have blinkers on because they just weren't expecting it, not really understanding the full picture?
Yeah, I think they're still unfolding the situation of that transition from the COVID era of working from home, staying at home, right? And that era where really all of these stay-at-home stocks like Netflix and Peloton reigned. But now I think we're shifting to an IRL sort of environment in real life, and it's perhaps a little too early to start seeing that flowing through to some of those retail sales. Of course, that missed here in the UK with data earlier today, but there is that shift starting to come through. It might take a little while for that to show up in the data, but we're definitely starting to see that now just on the ground.
So I think you said something earlier which really, made me think we're not buying the dip anymore. We're really selling this rally.
Absolutely, Francine. And I think that's really also characteristic of, what has led the rally over the last year or so, right, is very much this sector. And there was a good reason for it, I think, that this idea that, we're still in sort of this pandemic era, and all these kind of stay-at-home stocks were really all the rage. But now the rally, that being led by a lot of these growth stocks and tech sectors, now being vulnerable to, of course, the global shift to tighter policy. And then, of course, this idea as well of that shift from working from home to living life in the real world.
The real world. We can't remember what the real world, what is the real world? Coffee together.
Yeah, exactly.
You and I outside as soon as restrictions are lifted.
Yoga in the studio and coffee outside. There you go.
I'll pass on the yoga, but I'll join you for coffee and cake. Christine Aquino there on the markets. Now, we're also joined by Regina Borromeo, portfolio manager in the global macro team at Robeco. Regina, thank you for joining us. What a day to actually talk about the markets. Of course, a lot of concerns about what comes next. What would you point to, to say to someone to convince them that we actually need to correct more in stocks?
Well, I'm a fixed income investor, and we have started the year quite volatile across the markets. But an active investor such as ourselves will take advantage in asymmetric trades. And when you look at the global macro outlook, it is quite challenging. The Fed is tightening. We do see rise in political risk, as well as real yields have risen this year. And in an environment where real yields have risen, it's reminiscent of 2018, where a lot of risk assets underperformed. So one of the things that we are focused on in the fixed income space is that, the divergence that we're seeing, particularly in the two largest economies in the world, the U.S. and China. In the U.S., we're still seeing strong growth. U.S. unemployment is at pre-COVID levels. The housing market is still strong. So in a way, the dual mandate of the Fed has been met. So that's why,
Regina,
we are seeing them tightening.
Yeah, so what does it mean in terms of further repricing of the fixed income space? So there has been quite a correction in 10-year yield in the U.S. since the start of the year. But if you put it into a larger context, and also if you look at what fixed income has been doing to stocks, there's a lot more to go.
Well, yeah, I think there is more of correction that can happen in certain risk assets, particularly in the spread markets. And it's not just the Fed. I think sometimes as investors, we get focused on, one thing. And the other important factor that will affect risk assets is what's happening in China. China is slowing. We've seen the PBOC react and really do a full-scale cutting cycle there because, their growth driver, one of their main growth driver, which is property, is going through a downturn. The construction market is going through a recession. So you're going to see them continuing to ease. But we do see still a lot of risk, particularly in China credit spreads. Right now, there's asymmetric pricing we're seeing in China and Asia IG spreads. So that's a market where we're quite cautious in. But within that environment, we also are overweight China government bonds.
So that's interesting. You're overweight China government bonds because you're expecting them to have more, how do you play that, in terms of timing? So what are you expecting PBOC and in general authorities to do in China over the next 12 months?
Well, even though they've already cut parts of the lending rate, we still see that they're going to do further easing as well. So the market is still pricing another cut. Also, they could extend their toolkit. So they've announced potentially incentivizing many of their banks to increase lending. One of the things that's quite a concern is that when you look at the lower rated China property issuers, they are in distress. The China high yield market is over 2,000 basis points. Default rates are quite high there. So we think that currently the policymakers have been very good in limiting contagion and spillovers. But we do think that when you're dealing with a housing crisis, there could be policy or mistakes on the road, and that's why we're quite cautious in China spreads as well as EM risk assets.
Regina, very quickly, what do you do with Italian spreads right now, or Italian bonds, given the political situation that could unravel with the election of a new president shortly?
Well, I think that's one of the political risks that we're seeing in Europe. Yes, we have Italian elections next week. We as active investors, we try to be dynamic. And coming into this year, we were cautious in some of the political volatility. So we are underweight Italian spreads. We're going to see how the news shapes up next week. We can see that, if there's uncertainty that the government may stay together or collapse, this may delay some of the reforms in place. So I think that, we would try to create some room if we wanted to add some Italian risk in 10-year BTPs versus German bonds.
Great. Thank you so much, Regina Borromeo, their portfolio manager in the global macro team at Robeco. Now, coming up, what lessons can we learn from the response to the 2008 crisis? We'll be joined by Dame Manoush Shafiq, director of the London School of Economics and former deputy governor at the Bank of England. We'll discuss that next. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Dame Minouche Shafik is director of the London School of Economics. She was the deputy governor of the Bank of England, of course, deputy managing director of the International Monetary Fund, and the youngest ever vice president of the World Bank. How economic policy responds to the pandemic and the lessons we can learn from the 2008 crisis is also a recent focus for Minouche Shafik. She doesn't think we should repeat the austerity politics of 2010. Instead, her focus is on the green transition and tax reforms. And I'm absolutely delighted to be joined by Minouche Shafik. So thank you for joining us. It's always great to catch up, especially to get us started for some of the biggest challenges in February and beyond. Minouche, what does the government, the UK government specifically, need to do to try and tackle this cost of living increase, which means that a lot of households will really have it tough?
Yeah. Well, I think there is, the UK government and the Bank of England have very different roles to play. Clearly, the Bank of England's role is to control inflation and meet the 2% target. And there is no doubt that we are entering a tightening cycle. I think for the government, the challenge is to find out who's going to be most adversely affected by current inflation, and particularly energy and food prices, and make sure that the benefit system looks after those people who are most adversely affected, either directly through benefits or through other policies which support people who are affected by those price rises.
Minouche, it's really interesting that you want to talk about 2008 because you're a little bit of an outlier, Colin. This is, you say, look, let's look at 2008 and not do the same mistakes, where a lot of market participants will say, well, it's just, you know, it was a different thing because we haven't really lived through a recession, or we've suspended the economy. So then the policy reaction should be different.
I think it's exactly right. You know, 2008 was what, we used to call it the IMF a balance sheet recession. And it takes much longer to get out of those because you've got to work your way through lots of debt and other kind of structural problems. This was different. This was different. And I think there are a lot of lessons. You know, in 2008, I think most economists look back and think that countries imposed austerity policies a little too quickly. They were too concerned with debt accumulation, not realizing that we were going to have a long period of low interest rates in which countries could afford to carry higher debts for longer. And I think it's very interesting that those lessons seem to be being learned. If you look at the US, you look at the UK, you look at Europe, they are all doing huge amounts, unprecedented amounts, 20% of GDP amounts to support the economy, with things from furlough to infrastructure investment across the board. And they're willing to tolerate higher levels of debt because they know that it's important to support the economy through this crisis. So the policy response has been very different. And I think that's very appropriate given that the nature of the crisis is different. And we learned some bad lessons from 2008-10.
Yeah, we have lessons, but at the same time, I think that the UK is actually ahead of all of the G7 countries in trying to mend some of the public finances. It means that the government is raising taxes, right, at a time when inflation is also at a 3-decade high. So are they getting this wrong?
Well, I think at the moment, the tax increase that's being proposed is a very particular one. We could have a debate about whether it's the right one, but it's around funding the social care issues. I do think the government shouldn't withdraw fiscal stimulus prematurely. And I also think that this is a moment of opportunity for investment, particularly around the green investment in net zero. Interest rates are still historically very, very low. Government can borrow for very, very low rates. And the best way to get out of a debt burden is to grow. And so good investments now will enable us to repay debt in the future much more easily than crunching down on austerity at this particular moment.
Yeah, so Manoush, what would you do? I mean, do you need to also go through spending cuts or tax rises to make sure that then you're prepared for the next crisis? And I know we're talking about timings here if we don't want to repeat what happened in 2008, but what is the correct timing and timeline to see this?
Exactly. Well, I think it's too early now to look at spending cuts and tax rises. I think it's completely fine to announce future tax rises, and there are some areas where I think are ripe for that, such as a carbon tax would be an obvious place to start. And I think in most countries in the world, property is probably undertaxed and has been where huge amounts of wealth have been accumulated in recent years, and it's probably the biggest driver of wealth inequality in the world. So I think there are some opportunities to raise taxes. I just wouldn't start worrying about that right now. Instead, what I would worry about now is how to increase public investment and to stimulate higher levels of private investment so that we can raise our growth rates over the years ahead.
I know you've done also a lot of work, of course, on inequality and the fact that this needs to be addressed through policy and through government policy. What is the one policy that you would put in place to actually drive change to improve equality? I know some of our wonderful economics writers were looking at transport, to education, or other things that could make a more immediate impact.
Yeah. Well, in the short term, I think we can learn a lot from the furlough program and how successful that was in both saving households and businesses from crisis. And I think what I would be looking at is things like earned income tax credits and wage subsidies. At the moment, actually, the labor market is buoyant particularly in the US and in the UK, to a lesser extent in Europe. And so we will see rising real wages, and the question will be whether those stay ahead of inflation. And I think that's going to be the tricky dilemma, is will central banks be able to get inflation down such that we don't get into the sort of wage price spiral that was so scary in the 1970s.
What's your prescription for the green transformation? So first of all, are actions matching the words here in the UK? And what would you do, quickly to, again, make a real difference? Is it carbon pricing?
Well, I think carbon pricing is a necessary but not sufficient part of the story, but it is necessary. Carbon taxes are so efficient for getting into the nooks and crannies of the economy. You don't need to comply with a regulation. You don't need to read the label. The price just tells you what is good and bad for the planet. So I think we do need to think very seriously about a carbon tax, and the sooner the better. It's not the whole story, though. We need regulations. For example, solving the problem of electric car charging station is partly a regulatory problem as well as it's not just going to be a carbon tax problem. There's coordination issues and things that need regulatory solutions. And I think obviously investing heavily in green technologies and having public support for that in order to enable an acceleration of those innovations. So I think it has to be a multidimensional package. I don't think any country is doing quite enough fast enough. The UK is actually ahead of some others. But we need to go faster. I think that's clear.
Thank you so much for joining us, Manoush Shafik, and we'll have to get you back on also to talk about this public-private partnerships and what we could have learned from the pandemic. Now, coming up, we also get more market moves. It's been a wild ride, to say the least. This is on three main concerns. Of course, it's geopolitics surrounding Ukraine. It's some of the shaky earnings we've seen with Peloton and Netflix, and it's also what we see across the world. The big question, what does the Fed do next in terms of raising interest rates? That's all coming up ahead. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it has been a wild ride for two stocks in particular, post-hour trading session, and of course that's filtering through some of the concerns that we're seeing overall in the market. So the COVID-19 pandemic isn't over yet, but the boom it helped create for stay-at-home stocks appears to be vanishing. If you look at Netflix and Peloton, two of the highest profile stars of the lockdown era, both plunging yesterday, and it's just the latest sign that investors have probably moved on from the so-called pandemic trade. Now, coming up, we speak Italian politics with Matteo Renzi, the man who could become the kingmaker, one of the kingmakers in the process. He is the former Prime Minister of Italy, and that's a pretty interesting interview coming up. We'll do game theory. We'll see exactly what he and what the markets are worrying about, which is a spread between Italian and German bunds. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Market sell-off, tech tanks as sentiment sours on stocks, investors flee to treasuries in a bid to havens. Victims of the sell-off, pandemic stocks, while Netflix plunges after subscribers disappoint and Peloton slumps as it cuts production levels. Plus, line in the sand, President Biden says Russia will pay a heavy price if it moves into Ukraine. Anthony Blinken and Sergei Lavrov meet today, and we're live in Geneva. Good morning, everyone. TGIF, it's a wild ride for stocks. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So briefly, we go to the markets because we then also need to talk about Italian politics, but it's very clear that stocks in Europe, together with futures, bonds also gaining, as actually nerves are fraying. Why? First of all, we had some shaky company earnings, the prospect of higher U.S. borrowing costs, still unnerving investors. And then there's also, of course, how we deal with Ukraine and that extra layer of uncertainty in geopolitics. So we'll have plenty more on that every 15 minutes. Now let's get straight to the Bloomberg. First word news, here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. France is to relax some COVID restrictions from early next month on signs the Omicron variant has already peaked in some regions, including Paris. The obligation to work from home at least 3 days a week is to go, along with outdoor mask wearing. However, the government is moving ahead with a vaccine pass, which will require full inoculation to enter restaurants, attend theaters, or to get on an airplane. Now, Bloomberg has learned China is quietly urging banks to increase lending, ramping up efforts to combat the weakest economic expansion since early 2020. The PBOC gave so-called window guidance to large state-owned lenders and regional banks in mid-January, encouraging them to extend more credit to companies and to households. The U.S. House panel investigating last year's riot at the Capitol has asked Ivanka Trump to submit an interview. The committee has requested her voluntary cooperation on what it calls a range of critical topics. Ivanka Trump was a White House advisor, and the committee said she was in the Oval Office at times on January the 6th and the days leading up to the event. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. TGIF to you, Francine.
TGIF. Now, from Monday, Italian lawmakers will begin the process of choosing the country's next president. While Italy's presidential elections are notoriously unpredictable, the Prime Minister, Mario Draghi, is widely tipped for the role. Now, the former ECB president was only installed as Prime Minister early last year, taking over a stagnating economy and a country rattled by one of the world's deadliest COVID outbreaks. Draghi has used tough measures to bring the virus under control and is in the early stages of implementing a €200 billion EU-funded economic recovery and reform program, the union's largest. But many are now concerned that Draghi could enter the presidential palace for a less powerful role at a very sensitive time for Italy. Well, we're delighted now that we're joined by the man who was crucial, actually, in installing Mr. Draghi as prime minister, himself a former Italian prime minister. He's the leader of the Italia Viva party, and he's Matteo Renzi. Matteo, thank you so much for joining us today. First of all, would you support Mr. Draghi as president of the Republic?
Good morning, Francine. I support Mr. Draghi for everything because Mr. Draghi saved Italy in 2021. You remember the result in economy, but in every sector, in vaccination. So I think Mr. Draghi is our pillar, is our most important player. About presidents of Republic in Italy is very complicated to understand what type of role is the President of Republic.
Right.
President of Republic in France or in USA is the boss. In Italy, is a referee, is a moral suasion leader. So we can accept Mario Draghi as President of Republic if we have a very good new government, or you can continue with Mario Draghi as Prime Minister and we have a very good President of Republic. For me, it's the same.
So
the important is save Italy.
Okay, so who could replace actually Mario Draghi as chief of the government, supported by a huge coalition? So you need a huge consensus to also navigate, this quite difficult economy until you have the parliamentary elections in spring 2023.
Yes, but I have words of confidence about Italy, because 1 year ago, the situation was terrible. Crisis, lack of vaccine, difficulties in politics. Today, with the role of Mario Draghi, everything is changed. And for that reason, we have half of public opinion who think, okay, we cannot touch Mario Draghi as prime minister. And the other half is better to have Mario Draghi as president of the Republic, because the role of president of the Republic is a little less power, but a little less powerful, but with more time. My question is, don't worry about Italy. Italy is unpredictable, unfortunately, but with Mario Draghi as a player, we can play in every sector.
I know the thing is that markets are paid for exactly that, to worry about negative consequences, and suddenly they're worried a little bit about what could happen to Italy. So again, is there a candidate, and do you have 1 or 2 or 3 names? Is there a candidate that could become the prime minister, that could take over your Mario Draghi, have consensus, and keep spreads with German bunds at a level that would be acceptable to the markets?
I know it's not easy to combine together the opinion of market and the situation in Italy, because the rules are not clear. But my question, my feeling is a positive feeling, because I think in every solution, in the both solution, Draghi president of the Republic or Draghi prime minister, markets will be confident about Italy. Why? Because if Mario will become president of the Republic for 7 years, market will have a very important guardian and pillar of Italian reputation, of Italian credibility for 7 years. If he will remain president, prime minister, so president of Council of Ministers, he will be able to implement and continue in the processes of reform. So for the rules, I know for every Italian politician is easy to understand the rules. Abroad is not easy, but the question is, in the next 7 days maximum, next Friday, we will have a new president of the Republic. In both solutions, please believe in Italy.
I know, but the thing is that, for an American investor, it's very clear to understand there are executive directors and non-executive directors, and the president of the Republic would definitely be a non-executive director. So with Mario Draghi as president, do you believe that European Union funds could be at risk?
No, absolutely not. I understand the preoccupation of American investors. And I lost my job as prime minister because I tried to change the constitution. So I know what is the expectation of American or global investors. But at the same time, I have a very clear message for the investor. No problem in the both solution, because if Mario will stay as prime minister, the European funds will be good. In case of Mario, will be the guardian of institutions as president of the Republic, the European funds will be good. So for once, in this case, Italy is not the problem. And the problem for Europe, of course, is the necessity to have a vision for the next years. And I believe Italy have to play a role. But Italy is not problem for the next years. That is a new, because usually it was not that.
Mr. Renzi, how likely is it that Italy will actually hold a general election in 2022?
I think the general election in Italy will be for sure in 2023. So that is the only.
But it could happen this year?
In this year, it's impossible to snap election, to call early election, because in case of early election, we will lose more or less 45 billion of euros. So nobody in Italian politics could imagine to call early election. So don't worry. Election will be in the spring of 2023. For Europe, the priority today is look what happened in the French election, 10 April and 24 April, with a presidential election in France. But fortunately, Italian stability today is one of the most important assets for the future of European institutions. And for me, that is a surprise, good surprise, thanks to Draghi.
Okay, do you expect Silvio Berlusconi to actually officially drop out of the race to become president before the vote starts on Monday? And who are you expecting the center-right to coalesce behind?
First of all, Berlusconi is not a player of this match. That have to be very clear with the investors and with the other international friends. With all the judges you can have about Berlusconi, Berlusconi is not a candidate. Zero possibility for Silvio Berlusconi to become president of the Republic. That could be good only for the gossip newspaper.
Yeah.
No, not zero vote. About center-right, they have to decide if try to support Mario Draghi or try to create a majority, larger coalition. If you think last time I was prime minister, I remember very well, when we decided to choose the choice of Sergio Mattarella as president of the Republic, this decision arrived more or less 2 days before the election, because there is not a popular vote. Is the vote of a member of parliament. So it's a very technical and political vote. My opinion is the name will arrive probably next Tuesday, Monday, Tuesday of the next week. And in case of Draghi, we will have a new government. In case of new president, we will have a new president of the Republic with two fundamental asset skills. First, a good friend of Western friendship and the Western coalition and Atlantic coalition, that is particularly important today. And the second, a great supporter of the European Union. So stop populists in Italy. Stop populists in Italy.
Mr. Renzi, talk to me a little bit about the timeline. So how hard, will it be for governments, of course, parties to coalesce over one candidate to become president? How long are you expecting the vote to last?
Probably in the last 3 times the election arrived, or the 4th election or the 5th election. It's very technical, but to be more concrete, I believe all Thursday or Friday, 27 or 28, we will have the election. The name of candidate will arrive, I think, next Tuesday. Of course, that is time of call, discussion, because the President of the Republic is a referee. So every party has to participate to this decision. For me, the priority is stop the possibility to have a populist candidate, and that now is over, and at the same time guarantee a correct approach of institution. I dream a different constitution with the people vote and the election of president from the people. But today we have a different constitution, and so we have to accept this procedure and this liturgy.
Right. Focus on the task at hand. Thank you so much, Matteo Renzi. I know it's not going to be a dull week, and of course we'll be covering anything with Italian politics all of next week and beyond. The former Italian Prime Minister and leader of the Italia Viva party joining us this morning. Now, this is what we're looking at. A couple of breaking news stories on the Bloomberg terminal. The London Metal Exchange Chief Executive Matthew Chamberlain will step down. The LME really at the forefront of some of the changes in terms of the open outcry and some of the regulations over some of the commodities. So we'll keep a very close eye on that story. Also coming up, the pandemic is not over, but the boom it helped create for stay-at-home stocks appears to be vanishing. So next, we'll talk Netflix and Peloton. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, pandemic fatigue. Netflix shares are sinking in pre-market after its first quarter subscriber outlook disappointed. The streaming giant expects to add 2.5 million customers, much fewer than the 6.2 million uptake that the market was actually expecting, while Disney and Roku also slid. Meanwhile, Peloton has dismissed reports it is halting production of its connected fitness products, including bikes and treadmills. Now, the company's chief executive, John Foley, says he's considering layoffs and taking steps to improve profitability. Peloton revenue narrowly missed estimates in the second quarter. The stock has lost about 85% over the past year. Now, joining us for more on the market reaction overall, also some of the banks, some of the very cool and sexy stuff that we're seeing CVC trying to list, and for more on Netflix and Peloton, we're joined by Alex Webb from Bloomberg. Quick take. I mean, look at that. I have the A team, and we can really talk about everything and anything. So Alex and Danny, thank you so much for joining us. Alex, I don't know whether this is the end of the stay at home. Are people going to be like spending money in restaurants because we're no longer going to be watching stuff at Netflix, and why the market's reacting so badly to it?
Well, end of the stay at home as long as the virus goes in the direction that we all hope it is, knock on wood. Yeah, look, I think that a lot of these stay at home trends, we talk about stay at home stocks, they were a lot of them just bringing forward demand that they hoped would arrive at some stage anyway. So it wasn't necessarily they were creating new demand, finding customers that wouldn't ultimately land with them anyway. And so it's meant that when you come out of these lockdowns, then all of a sudden you've got to find new customers elsewhere, and that's a particularly tough challenge. Yeah, and what's also tough, I mean, if you're a tech stock, so first of all, you get it when, interest rates move, but that's kind of like the big one. So it's not necessarily the ones that are more like the stay-at-home stocks. Do we need to make a real difference between these two?
Well, they certainly are getting hit. I think it just kind of shows the extent of the problem for tech, that it's not just the Fed, but it's also the fact that when Alex goes to Mykonos next, he can't bring a Peloton or his TV with him.
Yeah, but he's bringing me.
I've got newborn babies. Mykonos is a long way from my radar.
Maybe so a completely separate problem, but right, it's not just the Fed anymore, and we saw this in the market, right? We saw bond yields, they did move lower in yesterday's session, they're moving lower in today's session. Typically it has been higher yields, tech gets wrecked, but instead it's the story that Alex is talking about. So the problem runs deeper than just valuations.
Yeah, could I just say, babies love Mykonos, especially twins. They're, they'll take it like a duck to water, straight to Scorpios. When you look at some of the things that, we worry about, is it investors valuing these, these stocks as too high? 2.5 million viewers is not bad when you have so many streaming services.
But don't forget, this is a growth stock, right? And so therefore you value it based on the pace of that growth. If the pace of that growth slows, you can see the result. It is interesting. I think when we think about these stocks, I talked about it a little bit with Danny earlier, they're almost more media stocks than they are tech stocks, right? And media is about people's attention. If people have left time to give you their attention, well, then you can see the end result. When you look at the, Microsoft, Apple's, well, particularly those two, Microsoft, Apple's, and Amazon's, that's a slightly different story. They're more diversified. Then you start to have to think about interest rates and the broader macro trends than necessarily, particularly what's happening with their earnings.
Yeah, I mean, you're also looking at banks. And again, banks kind of, they're getting, pillared because of how much they're paying their bankers, so costs are going up, but they should benefit from rising interest rates.
Yeah, they absolutely should. I mean, we learned overnight that Jamie Dimon, he's getting his pay increased. Not that, he needs a higher pay, but it does show just how well things are doing. He'll certainly be going, not bringing his Peloton, but it does show that in this environment, you perhaps do have to get a lot more picky with what you're choosing. I kind of cringe when I hear the phrase, it's a stock picker's market, but it's hard just to buy the entire tech sector, the entirety of the banks, because you have to look at, okay, whose expenses are rising, who's going to be benefiting from a better net interest margin. There are more differences, more divergences now.
Yeah, and it's, in 2021, it was hard not to make money. 2022 is probably another story altogether. Also, I love the fact that you have every streaming service available, including the US one.
I have
everything.
I may have a VPN.
Ooh, admitting it on air.
Well, we won't talk about that, but we will talk a little bit more about Netflix. Now, let's get straight, of course, to some of the markets. Our Danny Berger and Alex Webb. Now, coming up, efforts to avert a military conflict in Ukraine continue with the U.S. and Russia's top diplomats set to hold crunch talks in Geneva. We have that story next. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, Secretary of State Antony Blinken will meet his Russian counterpart, Sergei Lavrov, in Geneva today. U.S. officials have been working to clarify Joe Biden's remarks on the response to a minor incursion into Ukraine, warning the Kremlin that further aggression would result in major sanctions. Well, Bloomberg's European correspondent, Maria Tadeo, is in Geneva for the talks, and Rosalind Matheson, Bloomberg's executive editor for international government, joins us from London. So good morning to you both. Maria, what are the expectations on the outcome from this Blinken-Lavrov meeting?
Well, you know, Francine, we're expecting this meeting, as you say, to start in about 10 minutes. We believe it's going to go on for about an hour 30 minutes. Of course, the United States going into the meeting briefing that there is still possible timing to get a de-escalation here, to get a diplomatic solution to this. It is unclear, however. We know that what the Russians want, the allies, NATO and the United States cannot give, and what the United States wants to see, which is this pullback from the troops, is something that Vladimir Putin cannot afford to do at this point. So it is unclear where we go from here. The other thing that to me is very interesting, Francine, is that, of course, being here, speaking to, the Russian press that is located here, their perception is also very different about this meeting. They say that they're not really expecting anything to come out from this meeting, and that they believe that this is probably going to be a much longer negotiation. They're not really saying that there will be a breakthrough in this meeting. Of course, we'll have to wait and see. As I said, an hour 30 minutes for this meeting, starting in 10 minutes time.
And Roz, I guess, there have been very public signs of division between the U.S. and Europe. First of all, could that be a goal of Vladimir Putin? And does it really embolden him?
Well, that's right. The Russian president does like to exploit differences. He spots opportunities and acts on them. And certainly any sign of discord, I wouldn't call it disunity, but differences between the Americans and the Europeans on how to respond to him and how best to deter him is certainly something that he's going to take advantage of. And what we've seen this week are further examples of those differences, not only with the comments made by the US president, which they had to spend all of yesterday cleaning up, but also the fact that the Europeans will not commit to a proper package of sanctions. They don't want to discuss the details as yet. They say it shouldn't be formed as yet. It should be a penalty, not a deterrent. So certainly gaps there for the Russian president to enjoy.
So, Roz, I know it's very difficult to be, of course, in Vladimir Putin's head, but could the week that was embolden him to mount a limited but highly damaging attack on Ukraine?
Well, that's a growing concern, certainly. Does it have to be a full war in Ukraine? It could be a bunch of different things. Could he come in from the north or the south into eastern Ukraine? Could he carve off parts of eastern Ukraine, which are already separatist territories that want to break away from Ukraine? Would he get away with that? Does he really want to take over the whole country? Could it be that there's efforts to destabilize Ukraine from within? Can they use cyber attacks perhaps on Ukraine or Europe to get some action on their side? So it could be a bunch of different things, and that presents that problem again for Europe and the US, how to respond to what you would think of as perhaps as lower level actions by Russia, and that's really where they're going to find themselves hitting difficulty.
Thank you both for joining us. Our European correspondent Maria Tadeo in Geneva for us for the talks, and Rosalind Matheson, our executive editor for international government. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons will be in New York. Our Tom McKenzie here in London. It's a big market day, so it's not going to be dull looking at the markets. If you look at the European stocks, they're still concerned about geopolitics and, of course, shaky earnings. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It would be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Will rates go up? Yes. 4 times this year is a prediction.
The markets aren't asleep on this. The Fed has been very clear.
I think we're going to start seeing some pressure from all this hiking.
We have got some really big pressures mounting, which is obviously what the markets are reflecting.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
Happy Friday. It is 10 a.m. here in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, January the 21st. Our top stories today. Stocks are down, bonds are up, investors getting concerned over shaky company earnings and the prospect of higher interest rates in the US. The pandemic boon for stay-at-home stocks may be coming to an end. Shares of Netflix and Peloton plunge as growth hits a speed bump. And showdown in Geneva. The US and Russia square off in talks that could determine what happens next with Ukraine. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kaylee Lines in New York. Anna Edwards is off today. What a day. What a start to your Friday, Kaylee. It is risk off heavily across these markets.
I mean, really, what a week, Tom. It has been brutal out there, and it definitely was a risk off day in Asia once again to close out the trading week there. I will say, though, we did close off of session lows. Broadly, yes, it was still a down day. The MSCI Asia Pacific Index down about 0.9%. But really, you saw a kind of buying pressure coming in as we got closer to the close in Asia, whereas yesterday you saw the selling pressure at the end of the U.S. session. That was true for technology stocks, which, yes, did end the day lower by about 0.4% when it came to the Hang Seng Index. But at one point, that index was down about 1.8%. So really, it could have been a lot worse. But even if it could have been worse for risk assets, you definitely saw that bid for safety playing in the Asia Pacific session. One evidence of that is the bond market reaction, where you saw yields in Australia, for example, coming in about 7.5 basis points to just about 1.91%. And then, of course, safe haven yen also getting a bid off of the strength of the session, but still stronger against the dollar by about 0.1%, actually sitting at its strongest level going back to about mid-December, right now at 113.96, Matt.
You could see a little bit of a bounce, though, today, Kaylee. I mean, we do have all the risk-off indicators flashing, but if you look at S&P futures, they're not down by too much, only 0.1%. NASDAQ futures even are only down by less than 0.5%. You do see investors buying bonds, so seeking the perceived safety of government debt, and that's why the yield is coming down a little bit. And you see investors selling off crude. That telegraphs concern about demand in the economy. Bitcoin also down. It's been positively correlated, obviously, with risk assets. We've seen that proven many times over the past few days. Now at 38,893, so trading under the 39,000 level. But you just don't see futures, Tom, falling that much in terms of the U.S. market this morning.
Well, Matt, even here in Europe, you've seen some of the heavier losses of the session being paired. You are close to 1 month lows, though, across the European benchmark stock 600. You can see red across the screen, across the geographies here. The geopolitics as well, worth focusing. And, of course, we're getting to Maria today in Geneva on that shortly. But around this red line that Biden seems to have drawn now, and the question of what happens next, re Moscow and Ukraine. But the cyclical and the value tilt to Europe not really doing much to support things at the moment with that focus on earnings. We can switch it on then and see how things are playing out across these different asset spaces. You talked about the bond space, that rush to havens. We're seeing that reflected in the German bunds. You can see yields down 3 basis points. You are now back to paying the German government to hold your money. Across the European benchmark down at 1.3%, as I say, at about 1 month lows. The technology sector as well, faring badly as we saw. The Nasdaq 100, as you've been talking about, in correction territory, that is flowing into what's happening in Europe, down more than 2%. The semiconductor pace, particularly under focused, likes of ASML, the chip makers, and euro dollar getting a bit up 0.2%. So that is the shape of play across these assets. And Kaylee, I think you've got some lines for us as well.
Yeah, of course, we're continuing to watch the markets, Tom, but we're watching geopolitics as well. And happening right now, U.S. Secretary of State Antony Blinken is meeting with Russian Foreign Minister Sergei Lavrov in Geneva. For an audience on London DAB Digital Radio, we are seeing pictures of that meeting right now. It has just begun. And of course, we will wait for a news conference from these two later on this morning. But let's get the latest from on the ground. Our European correspondent, Maria Tadeo, is live in Geneva for us. Maria, the U.S. says there is still a diplomatic route here. What's the way forward?
Well, you know, Kaylee, that is a big question, and I wish I had an answer for it. But at this point, it's very unclear where we move from here. Now, overnight, heading into this meeting, the United States was briefing, saying that they believe Russia can still de-escalate tensions, that they can pull back those troops. And they've also said for weeks, we've seen major disinformation coming from the Russian side. The problem here, of course, is that what the Russians want, which is this very clear guarantee that Ukraine will never join NATO, is something that the allies cannot agree to. And of course, Vladimir Putin does not want to pull back the troops because it would seem like a defeat. So the way forward here is very unclear. Another thing, Kaylee, is the fact that we've seen again a major call for big, massive sanctions on Russia. We know we've had a number of hints in terms of what that could look like. But again, the big question is how united is Europe and the United States on this? How tough and how strong are they willing to go against Russia, Vladimir Putin, and the Kremlin?
Yeah, and Maria, as you're talking, we are seeing those live pictures of Sergei Lavrov and, of course, Blinken. You're seeing Lavrov right now, and they're lying crossing the terminal. Russia grateful to the US for these security talks. That is coming from Sergei Lavrov. We'll keep you across these lines, of course. Maria, you talk about sanctions, and you talk about the fact that there is, of course, difference within NATO and within European allies on how hard and how fast to go on these. What do we know about the details of potential sanctions that could come down the pipe if there is a military incursion?
Yeah, and by the way, Tom, Sergei Lavrov is a very, very experienced diplomat. And, you know, in terms of the sanctions that we could see, well, you know, we've had a number of hints that they would go after the dollar-denominated assets, that they would go after the banks, the big international Russian companies. But I guess the content, of course, really matters. The damage that could be done to Russia is key here. But the other big question, and this is really the question that I've been asking myself this week, is just how united will Europe and the United States be on this? We know that Germany's strapped in the Nord Stream 2 pipeline. We know that continues to create big tensions among European allies. And we've seen that until now, and this is very telling, the Secretary of State, Antony Blinken, had to come here to make sure that all of the European countries were aligned and speaking with one voice. So for me, it's not just the content that matters, but really that unity between the members of NATO.
Yeah, no, that's absolutely key, Maria. Thanks very much for joining us. Maria Tadeo, there live in Geneva ahead of these meetings, or as these meetings kick off. Meanwhile, back in Washington, D.C., Democrats are assessing President Biden's economic agenda again, battling over the same tax and spending proposals that have bedeviled the plan for months. Emily Wilkins, Bloomberg government reporter, joins us now out of D.C. So, Emily, what do we know about Build Back Better being broken up?
So at this point, the message from congressional Democrats is that it's not dead yet. Yesterday, House Speaker Nancy Pelosi said that she could support a slimmed-down version of that legislation. You heard President Biden suggest that it might not include things like the child tax credit, something that we've seen Senator Joe Manchin raise some concerns about. But we also know that Manchin is supportive of other items in the bill, and Democrats are trying to make it clear that they still have momentum to move forward. Now, President Biden did talk about breaking breaking that bill up. But Speaker Pelosi had a reminder for everyone yesterday. This is being done through that reconciliation process, and that means there are certain limits on things. If you break this bill up into smaller pieces, it doesn't necessarily mean that everything can pass or that they can even use the process.
Hang on, Emily, the child care tax credit and the SALT deduction, these are the two most important issues probably politically, certainly here in the Northeast. These are not going to be included in the slimmed down bill?
There's a big question about that because we've heard from a number of lawmakers who say, look, we're not going to be okay passing legislation that doesn't have that child tax credit in it. So at this point, that does seem to be a point of contention on exactly how it's done. Remember, and I hate to go back to Joe Manchin again and again, but he really is a key figure here. One of his concerns about it was that right now, too many people are getting that tax break from the government, that they need to narrow the window of people who are getting that benefit. So that could be a potential way to go forward on it. Certainly, there are many supporters in Congress, both for that child tax credit and, of course, for that SALT tax. You did hear a restatement from a number of Democrats saying that they would not support legislation that does not have the SALT tax in it. And I think this all speaks to the challenge that Democrats have before them for actually slimming down this piece of legislation, which, quite frankly, has already been greatly decreased from what it was initially.
Yeah, the slim down of the slim down for this bill. Emily Wilkins of Bloomberg Government in Washington. Let's switch focus to some of the big corporate stories within this earnings season. Then Netflix and Peloton, two of the highest profile stars, of course, of the lockdown era, both plunged Thursday. That's the latest sign that investors have moved on from the so-called pandemic trade. Netflix expects to add just 2.5 million subscribers this quarter. That is well short of estimates. Let's get more then with Bloomberg's Danny Berger. Danny, just how bad were these numbers for Netflix? How concerned should we be about this business going forward?
Well, a 20% plunge post-market, 20% pre-market, that gives you an idea of just how concerning these numbers were. The fact is that for both Netflix and Peloton, really stars of the stay-at-home trade, that is played through. That era is over. Now the concern is next time Matt Miller goes to Mykonos, he's not going to be bringing a Peloton or a Netflix subscription with him. So these now giving up their gains that they saw during the pandemic. And this is really significant because over the past year, over the past 2 years, really what was able to keep this market afloat were tech stocks, were these stay-at-home trades. So now with both of these coming under question whether their earnings can continue on to grow, you're seeing another leg knocked out of this bull market.
Yeah, how much further do we expect these losses to go? In terms of the NASDAQ, I mean, everyone's talking about correction, but John Authers had a great column saying he doesn't think the price is quite correct yet.
Yeah, don't call it a correction yet. There are plenty of people who don't see capitulation in this market. And of course, we need that capitulation to say, okay, investors are happy to step in and go ahead and buy the dip. We've seen a lot of these various metrics when it comes to moving averages. People haven't been as willing as they were in the past to step in and buy the dip. And really one of the key sentiment measures here that suggests that this could go on longer is it's not about yields anymore. We had a very reliable pattern over the past few months where yields went up and tech sold off. Well, Kaylee, you were talking about this in your market check. We've seen yields move lower. People have been buying treasuries, and even so, they are selling tech. So it's more about valuations. It's now more about that fundamental earnings story as well.
All right, Bloomberg's Danny Berger, thank you so much for that great roundup. I do want to get to some breaking news. This out of Airfinity, lowering their 2022 COVID vaccine sales estimates due to the Omicron variant and the milder disease that it seems to cause. They have now cut their COVID shot sales view to $85 billion. That's down from $118 billion. You are seeing some of those vaccine makers lower in pre-market trading. Moderna down 1.8%, Novavax down 4.8%. And as for some other stocks moving to the downside in pre-market trading, Danny was just doing a great job of running us through the Netflix story. And I would note that that is not just affecting Netflix shares today. It is affecting shares of other companies that have big streaming operations, the likes of Roku and Disney, which are down in pre-market trading. Roku, the underperformer within that. And then, of course, you also have Bitcoin, which is under pressure today, as Matt was talking about earlier, below that $40,000 level. And that is weighing heavily on crypto-related equities this morning. The likes of MicroStrategy and Coinbase are lower today, Tom.
Okay, Kaylee, of course, a huge theme for every investor right now when it when the focus is on these earnings, is unpacking what's happening with wage growth. We're getting a line crossing. This isn't related to corporates, but it just builds into that theme. A redhead crossing the terminal right now. This is according to Axios. The US raising its federal employee minimum wage to $15 an hour. So $15 is what you're looking at in terms of the minimum wage at the federal level, according to Axios. We'll get more on that. We'll bring that to you if we get more on that. Okay, coming up next and after the breaks, back to the markets with Peter Shafrick, RBC Global Macro Strategist. And on the disappointing results from Netflix, Mark Stokel, Adams Fund CEO and Senior Portfolio Manager. Plus, a super bubble in stocks. We're going to get the view from famed investor Jeremy Grantham. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is affected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Kaylee Lyons. Tom McKenzie is in London because Anna Edwards is off today. We are simulcast on both Bloomberg Radio and Bloomberg Television. Nonetheless, we occasionally use charts. Of course, if you're listening in your car or in your office, you can't see them, but I have one in front of me that is really striking, and I'll walk you through it. Investment-grade corporate debt has had its worst start in decades. In fact, we're looking at a drop of more than 2%, and we haven't seen that anywhere in the last 20 years. Nothing even close, to be honest, with the exception of a drop of almost 1% right before the great financial crisis. So why are we seeing such a huge sell-off in safe corporate debt? Joining us to talk about this is Donna El-Baltaji, Bloomberg's managing editor for credit in EMEA. So Donna, it seems to me, you know, if you were looking for a place to hide, if you're really worried about preserving capital, and if you had time, this would be a great place to hide, but the timing is really the problem, isn't it?
The timing is absolutely the problem. And you know what? It also depends on what you're hiding from. In this case, you are hiding from interest rate rises. And what you want to avoid is duration. Now, for the IG indexes, you really have higher duration. You've got lower duration for high yield indexes, which is why those indexes haven't done as badly, but also because the yields there offer a kind of a buffer from higher inflation, which, as we can see, is not going away. We are seeing inflation readings that are surprising, and they are making people quite nervous about what will happen with earnings going forward.
Donna, we talked about the cash on balance sheets, particularly within PE, and we've seen them snapping up some deals here in the UK, particularly within the supermarket space. But it may not be as benign as it looks on the surface. Is this financial leveraging that's going on here with these junk bonds that are being added to these companies? What's the picture?
Oh, absolutely. You know, and I mean, what we're seeing is that there is a lot of demand for some UK names, but what happens with that is that you pile all of this junk debt onto these names. And of course, the more debt you have, the riskier name you become. And that's what's happening here in the UK. The reality is that UK companies are quite cheap when you compare them to others. And so therefore, they are quite ripe for these buyouts. However, the credit quality is really what suffers here.
And when we just talk about the broader macro policy environment and the potential tightening of financial conditions, how quickly could we see that starting to bleed through to credit?
Oh, we're already seeing that bleeding through to credit. We're seeing it across all asset classes. It's now not really a question of whether or not which index has done well. It's now a question of which index has done less badly. So even as we look across all of them, we see red everywhere. I don't think I've seen a single index that has done well this year, actually.
Okay, Bloomberg's Donna El-Bartaji with a fantastic breakdown of the credit space and some of the things to watch for as we move through this year. And for more market analysis, check out MLIV. Go on your terminal. This is Bloomberg.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Bloomberg is fastest with the numbers and analysis.
I'm going right to return on tangible equity.
They missed on FIC trading.
They're too hot.
Bloomberg, the fastest numbers and analysis you trust.
EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast, and we plan to have a few more $1 billion investment.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think what we've seen during this period of time is that
communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Tom McKenzie in London. Anna Edwards is off today. Now let's get the first word news. And China is quietly urging banks to increase lending after a slow start to the year. Bloomberg's learned that the PBOC has given so-called window guidance to large state-owned lenders and regional banks. It urged them to extend more credit to companies and households. Bank lending in the first 2 weeks of the year was lower than a year ago. The Federal Reserve took a key step in weighing the creation of its own digital currency. It's a move the central bank says could help ensure the dominance of the U.S. dollar. The Feds came out with a paper saying the central bank digital currency would be a highly significant innovation, but it won't move on the idea unless there's support from the White House and Congress. Bitcoin fell today to the lowest level in more than 5 months. The world's largest cryptocurrency dropped below $40,000. It had hit a high of almost $69,000 back in November. Other crypto coins are falling too, and virtual coins, of course, have become a symbol of the retreat in speculative investments sparked by the prospect of tighter monetary policy. And it's a good day for Jamie Dimon. He is being rewarded for JP Morgan's most profitable year on record. The bank has raised its CEO's total compensation by 10% to $34.5 million. That includes $28 million of restricted stock tied to performance. JP Morgan's profit rose 66% last year. And Matt, what strikes me is this is a week ago now that JP Morgan reported higher than expected expenses, a jump bigger than analysts really wanted to see and investors really wanted to see. The stock got punished for it, and yet here they go, the board giving Jamie Dimon a pretty big pay increase.
Yeah, well, I mean, it's not that big when you take out inflation, right? Then it's only a 3% increase. But my first thought was he's not the highest paid guy at the bank, right? A lot of people who work for Jamie Dimon are getting paid a lot more. I always find that interesting with these bank CEOs because we make such a huge deal about their pay, but you got to consider the value that they create for investors. And this week, notwithstanding, he's done a really good job of that for JP Morgan.
Yeah, there'll be the usual hand-wringing over this, you know, the pay issues. There always is, and it becomes political and everything else. But he is obviously a grandee of this industry. I thought it was remarkable, just back to your point, Kaylee, Mike Mayo from Wells Fargo coming out. He'd been bullish on the stock for 7 years, then he cuts it, downgrades it, because he doesn't get enough clarity on what they are doing around compensation and those tech investments.
Yeah, and it's not just a story with JP Morgan, right? We're singling them out here because of this Jamie Dimon pay raise, but this is something we saw across the banks. At Goldman, expenses were up, at Citi, expenses were up, at Morgan Stanley, expenses were up, because there is a serious war for talent out there, and if you want to compete, you have to pay up, Matt.
Yeah, absolutely. I can't believe you didn't mention Meatloaf. I feel like that should have been included in the first word brief. We lost Meatloaf, 74 years old, from the famed album Bat Out of Heck. But also, I thought he was really good. Tom, did you see Fight Club? Meatloaf was great in Fight Club.
Oh, he was fantastic. Yeah, well, he
Don't
had
talk about
certain. Yeah, we're not going to go there. He was amazing. I'm just getting flashbacks to that image now. Don't Google image it. All right, coming up, we're going to switch focus back to the bond markets, back to what's happening in fixed income and currencies with Peter Shafrick of RBC, global macro strategist. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kaylee Lines in New York. Anna Edwards is off, and here is what you need to know. European stocks and US futures are lower. Investors are concerned about the prospect of higher interest rates as the Fed fights inflation. Some disappointing corporate earnings are adding to worries. Meanwhile, the 10-year Treasury yield fell. Investors may be saying goodbye to the pandemic era of so-called stay-at-home stocks. Shares of Netflix plunged after the streaming service said it expects to add only 2.5 million subscribers this quarter. Meanwhile, Peloton is slashing costs to deal with slowing demand for its exercise bikes. And US Secretary of State Antony Blinken and Russian Foreign Minister Sergei Lavrov began security talks this hour in Geneva. At the start of the meeting, Blinken said, quote, "This is a critical moment." Lavrov told Blinken Russia is, quote, "grateful to the US for participating in the talks and expects to receive a response to its security demands. That is a look at what you need to know this morning. Matt, what do we need to know about how the markets then are positioning?
Well, we had some dramatic stories of loss yesterday in terms of Netflix and Peloton. It looks like that trade may be coming to an end, but I have seen the green. S&P futures right now down 0.04%, but just a moment ago they flipped higher. So the question is, do these, retail favorite acronyms, BTD, TINA, and FOMO, come into play today and push us back up after the discount that we got over the last week? The U.S. 10-year yield is still down, so 178.47 means that investors are still seeking the safety of government debt, and doesn't look like people are terribly bullish on the demand picture for oil. Right now, NYMEX crude down to 84.08. It's still a relatively high level, but we were pushing up towards 90, and that seems to have taken a pause. Bitcoin probably the most disappointing for risk indicators today because it was down below 39,000 for a bit. Kaylee was pointing out earlier. Right now, $39,000.34. It's been very positively correlated with risk assets, and off 5.5%. That doesn't mean anything good. Kaylee, what do you see in terms of pre-market movers?
Well, Matt, you name-checked Netflix and Peloton, so I feel like I'm obligated to talk about those. You are actually starting to see a rebound taking shape for Peloton after a 24% plunge yesterday on that report that they are halting production due to waning demand as we hopefully emerge from the pandemic world. Right now, though, investors seem to think maybe that sell-off yesterday was overdone. There's a buying opportunity this morning because right now that stock is up about 7.4%. But for that other stay-at-home player, Netflix, it is really, really ugly this morning. Those shares plunging to the downside by about 20 percentage points after the subscriber outlook for this quarter came in well short of analyst expectations. And Matt, you were talking about the declines we're seeing for Bitcoin and oil. That is translating through to equities tied to those assets in pre-market trading. You have a lot of crypto stocks like Riot Blockchain down. It's down the better part of 7 percentage points. And then energy players like Occidental Petroleum down about 1.7% at this point, Tom.
Kaylee, that call from strategists that Europe and European stocks are going to do well this year because of that tilt to values and cyclicals, that is being challenged right now with these losses of 1.3% across the benchmark here in Europe. I want to focus on technology as well. The read across from the US, you've been talking about the earnings picture and the question marks about the rate of increases from the Federal Reserve and how that is playing out. It's the semiconductors, particularly under pressure here in Europe, that this space now down more than 2%. And in terms of the bond markets, that bid for safety that Matt was talking about when it comes to US Treasuries, that is being felt here with the German bunds as well. Bid up. The yields are down 3 basis points. The price is up. And currently, you are now negative again. You're paying money for the German government to take your cash, paying them. In terms of euro dollar, you're looking at gains of 0.2%, a bit of a bid again in terms of safety for the single currency. The focus on geopolitics as well as that meeting gets underway in Geneva. Matt.
All right, now let's talk about rough predictions. Famed investor Jeremy Grantham, famed bear, I should say, says the historic collapse in stocks that he predicted a year ago is underway. Speaking in an interview exclusively with Bloomberg's Eric Schatzker, the GMO co-founder gave his prediction on where the S&P goes from here.
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
Joining us now is Peter Shafrick, RBC Global Macro Strategist. Peter, I thought this interview with Jeremy Grantham was alarming. On the other hand, he has been known to make incredibly bearish predictions on a regular basis. What do you think about the possibility that we could just see a collapse in global assets from, you know, real estate to stocks, and that the Fed or central banks can't do anything about it this time?
Yeah. So, I mean, first of all, obviously there are some risk signs out there, but you know, it's not a scenario that we are seeing. I mean, the economic underlying picture that we think will unfold both in North America as well as in Europe is still extremely healthy. And yes, of course, let's say in the equity market, valuations can come down if bond yields keep going up, as we think they will. But on the other hand, you know, if you still have relatively healthy earnings growth, it seems unlikely to me that we get a collapse, as you just coined it.
But Peter, we're not just talking about bond yields going up. We're talking about bond yields going up with pretty incredible velocity. I mean, the 10-year yield was at 150 not too long ago, about 3 weeks ago. Is it so much where the yield ultimately gets to or how quickly it gets there that's important?
Well, I mean, I want to stress another point, really, because when you look at sort of the composition of bond yields, and I think I mentioned this a couple of times, we have a very different picture compared to, let's say, the last time we've been at round about these yield levels. Because what we have now is we have relatively high inflation expectations, but relatively low real yields. And that's true across the board in most of the developed markets. And the increase that we've seen lately, yes, it came out of real yields, but it's still, if you look at 10-year real yields in the US, in Germany, in the UK, they're still all extremely negative. So I think the picture is very, very different compared to also how it was in 2017-18. So the increase in nominal bond yields that we're seeing this time around does not represent the same kind of monetary tightening or financial tightening as we had, for instance, back then.
Okay, so obviously it's not quite, as you point out, like we're seeing positive real yields. We're still negative by about 54 basis points on the 10-year real rate here in the U.S. But even so, the move has weighed heavily, in particular on growth stocks like technology, which makes up the bulk of the market here in the U.S. Can equities do well if tech is not doing well?
Well, I mean, if you look at the broad indices, obviously it depends on how they're weighted. And you had sort of in your moderation earlier over here in Europe, for instance, we've got a lower share of tech. But clearly, in my mind, going forward, there will be winners from the next phase of the expansion, very clearly. I mean, if you just look at the performance of banks, for instance, as an example, and there will be losers. And if you look at the various markets, those that are more heavily weighted towards, for instance, tech stocks, they're probably not going to fare that well. But those that are heavily weighted to those industries that are going to perform well in the next leg of the recovery, they're probably going to do much better. So I would concur with, for instance, what you said earlier, that some of the European names are probably going to be quite well situated to do well going forward.
Peter, do you draw from that then that you think Europe is going to outdo the US on the equity level this year? Is that a theme that we can follow?
It's always a very brave call, but it seems to be that in an environment that we're going into, in an interest rate hiking environment, there is probably some catch up to do, particularly sort of when you think about that the US Federal Reserve is probably going to outpace most of the European central banks. So I think there could be an element here.
Okay, just switching focus, just because I'm standing here in London, to what's happening in the UK. We had consumer sentiment coming in very weak for the month of December. We've got the BOE and a hike priced in for February. How challenging is it for the central bank of the UK to navigate these waters as the economy faces these challenges? And what is the read cost to UK equities that have been underplayed and undervalued, at least, versus what's happening in the US and Europe, certainly over the last few years?
Well, I mean, first of all, on a structural basis, there are challenges for the UK economy, and we can debate them until the cows come home. But, in the here and now, the economy is doing incredibly well. I mean, the labor market is extremely tight, and the forward-looking indicators for hiring intentions are still very strong. The vacancy rates are very high. So overall, the economy is doing quite well. And when you look at the whole sort of broad suite of measures, a suite of indicators, and that's the picture that's been painted. And we think that the bank will hike again in February. And then the next step really is that they're going to embark on a QT program. And we'll have to see how that impacts the market. So, but overall, I think the UK economy is doing well, and with it, the UK markets are likely going to do well as well.
Okay, Peter Shafrick of RBC and the opportunities here in the UK, Europe as well, as we face up to these changing faces, of course, of monetary policy, ECB and the Fed. Okay, coming up next, Netflix's plunge. We're going to discuss the company's outlook with Mark Stockler, Adams Fund CEO and Senior Portfolio Manager. Stay with us. This is Bloomberg.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Beyond Net Zero Chairman John Brown. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Tom McKenzie in London today. Anna Edwards is off for a long weekend. Well, let's get back to tech and the movement in pre-market trading. Netflix plunging after it said it expects to add just 2.5 million subscribers this quarter, a number that falls well short of Wall Street's estimates. That would actually mark the slowest start of a new year for the company in at least a decade. Joining us now for more is Mark Stokel, Adams Fund CEO and Senior Portfolio Manager. Mark's top holdings include big tech like Microsoft, Apple, Alphabet, and Amazon, and Netflix is also one of his holdings. Mark, I got to ask you the obvious question. What do you do with that Netflix position this morning?
Well, it's the question of the day, certainly. I think it is a disappointment, but I think there are a couple of things that people should keep in mind. First, it ended yesterday at a 22 RSI. So technically, if you look at a technical chart, down 20%, has pretty good support level. So from a technical perspective, I think it should give you a floor. I think from a fundamental perspective, there are way too many questions that need to be answered and need to be really vetted in order to get more bullish on the company. I think it's the sub growth, as you just mentioned, is quite disappointing. When you look at what was expected, which is 24 million for the next 2 years, and you come out with 2.5 in the first quarter. And by the way, I think an important consideration here also is they had a really good content slate in the fourth quarter of last year. And the subs were fine in that quarter, but there's really no follow through, which is also a bit troubling.
So I have a question kind of to round it out about a stock that you don't hold, at least in any size, and that is Peloton. It's fallen below its 2020 level, which, you know, I can understand taking away some of the exuberance that we got during the lockdown, but isn't it still a brand that is now cemented in consumers' minds when it comes to this industry? And isn't it trading at the kind of discount that you might want to pick up?
The short answer is no. I don't think so. I think there's a very big difference, and I'm glad you brought up Peloton because to me there's a very big difference. The Netflix business is a really good business. It's just slowing growth, so it needs to be revalued. I mean, we need to figure that out. With Peloton, it's a great brand. It's not a $10 billion company. I mean, it's just not. And I think that there's the difference between the two is pretty stark. Is it a good company? Yes, it's a great product. People love it. But what are you going to pay for that? You know, the razor blade part, the $39 a month, is not going to support as big a valuation as it has been. And the fact that the units have slowed down both on the treads and on the bikes is very very disappointing. And frankly, I think points out this is not as durable a business as people had expected it to be. And by the way, we do not own Peloton.
Okay, Mark, a couple of names you do own, Alphabet and Amazon. Can we draw a straight line from what's happening with Netflix to those companies, or does the advertising part of those businesses sustain them through this earnings season?
Yeah, I don't think you can, and I think that the Netflix issue is if you want to try to have draw companies around that. Certainly the other streaming. That's why Disney will be down again. Will be down today. I think the streaming business. And Netflix even brought it up for the first time that I can remember that competition is an issue. So I think that's important. But that's a Netflix streaming issue. That's not a big tech issue. Now, it could happen that way. People might put a little pressure on tech because of that. But Netflix is the more interesting part to me, I think, is Netflix is in the communication services sector.
Yeah.
And the big dogs in communication services are Google and Facebook. So what you could end up seeing is some money being taken out of Netflix and going into Google and Facebook, because the growth and the consistency, the free cash flow is much more robust at both of those companies if you're looking to find weight in the communication services area.
So, Mark, when we talk about tech more broadly, as we've done a lot over the last week, as we've seen tech sell off, do we need to treat large mega cap tech stocks, the likes of Meta and Apple and Amazon, differently from the broader tech complex, in your view?
I think the short answer is sort of. I do think that, I mean, if you think about it, you've got value tech, whether it's IBM, HP, some of those companies. You've got the tech that you just mentioned, and then you've got the hair on fire, valuation crazy tech. And I do think that you could put them in three different buckets. I think value tech at least in our opinion, is still hard to accept. That the IBMs and the HPs are going to be able to carry the day. I think the hair on fire, unbelievably high valuation, multiples of revenue are also hard to, especially with interest rates going up. But the tech that you mentioned it's durable, it's consistent revenue growth, partly because of advertising that was just mentioned, and it's also free cash flow generators that really can carry the day. So I do think that there are at least three different buckets within tech that you could be looking at.
Okay, the need to discriminate within this tech space. Mark Stokel, thank you. Adams Fund CEO and Senior Portfolio Manager. Coming up later today, we're going to continue the conversation on tech with Intel CEO Pat Gelsinger. That is going to be at 5 p.m. in New York or 9 p.m. here in London. This is Bloomberg.
And behind me, you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Tom McKenzie in London. Anna Edwards is off today. And also joining us, Tom Keene, co-anchor of Bloomberg Surveillance, which, of course, we all will be watching a little bit later on. Tom, also, a lot of us are watching Netflix, but a lot of people, I guess, aren't, or that growth is slowing, and that really seems to be the individual story of the morning.
I'm so brain dead watching all my Netflix shows last night. I had to steal a chart from Danny Berger. Let's do it right now, folks, much like what Danny showed, 40 minutes ago or so. This is the FANG stocks. I separated out Netflix in red and the Standard & Poor's 500. This goes back to the beginning of the great Ben Laidler bull market. SPX with a nice linear movement. The FANGs outperforming over the last 2 years. And, of course, a drop-off here of 20% on Netflix, under what we've seen from the Standard & Poor's 500. We'll see how that all settles out here as we try to figure out what's on after the Queen's Gambit.
I've been watching Longmire. And
Okay.
I'm not sure if I'm wasting my
Is this a recommendation?
time. No, it's definitely not a rec. Don't do it. But what's the problem here, Tom? Is it just that it's saturated, as many of us who were going to get Netflix already have Netflix? Or is it that people don't know how to value Netflix? Or are they spending too much on content? What's the main issue?
To me, the arch issue here, there's two issues, and you nailed one of them, which is the new competition. All of a sudden, everybody's piling in, and Paul Sweeney, who's truly expert on this, would suggest there's a lot of competition and a lot of sorting out. Netflix wins in a lot of those decisions, but the other one is the ability to make profit. And when you hear me talk about the new defensives, that's a phrase I've stolen from some of our smart guests about tech companies that actually mint money. Think Microsoft. That's not Netflix.
Yeah, that's something we were just discussing with Mark Stokel
Yeah,
of
I know,
Adams Funds. Thank you so much for discussing with us as well,
she just
Tom Keene,
dismissed me.
co-anchor of
You see how
Bloomberg
she
Surveillance.
dismissed me? That was rude.
That was not a
dismissive of
dismissal,
Tom.
Tom. That was a thank you.
He could stay.
A genuine thank you. Yeah, we're just going to talk about
I
what
gotta
else
go to makeup.
we're watching today. All right, you enjoy that. We'll see you on Bloomberg Surveillance in just a couple of minutes. In the meantime, I am also paying attention to geopolitics. The Blinken-Lavrov meeting happening in Geneva, that began about an hour ago. We heard some comments out of both of the U.S. Secretary of State and the counterpart in Russia. Lavrov saying Russia expects response to its security demands. Blinken saying the U.S. wants to test that the path of diplomacy remains open. But obviously, this is a very, very tense time as Russia has built up troops on the border with Ukraine. The Biden administration has been really struggling with messaging around this week, Matt, so it'll be interesting to see if anything really productive can come out of these talks today.
Yeah, I actually think Maria Tadeo nailed it. The importance is unity in NATO, in Europe, and the problem is there isn't any, right? They're so dependent on Russian gas that they can't bring themselves to commit. I'm watching CBDC, which is not a new kind of hemp oil muscle sore treatment. It is central bank digital currencies, and the Federal Reserve took a key step in weighing the creation of its own CBDC by putting out a paper and asking for opinions. This doesn't mean they're necessarily going to, but they're taking one step in the direction of issuing a digital dollar, which is interesting. Tom?
I had a brief image there, Matt, of you oiling your biceps. I'm looking at political risk in Italy. I'll just leave with you briefly the gun show. Mario Draghi, the politics of Italy, the presidential vote, they've had stability there. That could change. Watch Italy. Plenty more coming up. Bloomberg Surveillance. Stay with us. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
The Fed's history is they break something when they raise rates too much.
As always, the question is what's different this time?
I think we're going to get this realization that the economy isn't quite as good as we thought.
This is a lopsided market with some industries outperforming and some sectors outperforming.
We think that real yields start to rise this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Blinken and Lavrov head to Geneva from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market unchanged on the S&P, still negative on the Nasdaq 100, down 46. Tom Keene, geopolitics front and center.
The geopolitics front and center is an overlay, John, and I see it in the markets through strong Swiss franc. There's no question about it. Swissy gets stronger. There's some real key points of new Swiss strength, and that's one of the issues of the tensions in continental Europe. The breaking news now, John, it's buried within the Lavrov-Blinken meetings in Geneva. Our Maria Tadeo there is the U.S. authorizes the delivery of Stinger anti-aircraft missiles to Ukraine. This is a very much, John, a developing story for all of Bloomberg surveillance.
TK, we had the Cleanup Act for about 24 hours following the president's news conference a couple of evenings ago. The quote, it's one thing that's a minor incursion and we end up having to fight about what to do and not to do. Tom, is the toothpaste out of the tube? That's the issue now.
Well, the toothpaste out of the tube, John, you've been very good about talking about Nord Pipeline, things that make my eyes glaze over, but the answer is, thank you, but the answer is this is from the Times, this phrase, a fully coordinated plan. Where is a fully coordinated plan among Western allies, among NATO nations? John Mearsheimer at Chicago was 10 years in front of this. There isn't one.
Lisa, that's the politics. Let's talk about the news in this market. In the pre-market, there is only one name to speak of. It's Netflix, and down it goes, down 20%.
Yeah, down 20% after they said that they expect the new subscriptions in the first quarter to lag way behind what the Wall Street analysts were expecting. The key issue here is how much do we bring forward demand and how much do we see a real lagging rebound? And we really are not seeing it go back to pre-pandemic levels in terms of them gaining traction. How much is this a precursor for what's to expect next week?
That stock down 20% or so in the pre-market, Tom. The Nasdaq 100 in correction territory. What to buy and what to run away from. That's what we've got to figure out.
I listened to the conference call on Netflix, and there was, the CEO going, baby, we can talk all night, but that ain't getting us nowhere. John, that's Meatloaf.
I know that's a tribute to Meatloaf.
No, that's a tribute to Meatloaf. Okay, I'm not going to sing it.
Do you want to make that tribute a little bit more explicit, though, Tom?
Meatloaf dead at 74, a great loss. Somebody had a lot of courage, frankly, to get out there. He was rejected by everybody out there before.
This is heartwarming.
70 success. John, Netflix, let's look at the free cash flow. I hate when the media bundles the fangs together. Let's look at Microsoft buying Activision out of the piggy bank versus Netflix. Free cash flow, 2019 out to about, pre-pandemic out to about now. Netflix, negative 3.1 billion out to 1.1 billion. Microsoft, look at the difference in size, John. On radio, Microsoft is ginormous. That's all you need to know. 38 billion large out to 65 billion.
Yeah, I don't think you can compare those names anymore, Tom. And there's been pushback. Let's remember, Tom, even at the time when FANG was all the rage, there was pushback even then. I think that pushback is very much justified this morning.
Yeah, and John,
I don't think you're going to get Microsoft numbers, then cut the stock by a fifth, Tom, the following day.
John, I know we got to get to Greg Bottle and an important data check, but I told you everything I possibly can. There's nothing left inside of here.
This sounds like the promo. We've got a morning of this. Thank you, Tom.
Thank you.
Futures -3 on the S&P. We're down 0.1%. We're down 56 on the NASDAQ 100, down 0.4%. It is brutal out there. I'll bring you some stats on the NASDAQ 100 a little bit later. From +1% to -1%. Bespoke saying this, Lisa, the first time in over 20 years that the NASDAQ was up 1% intraday and finished down more than 1% on back-to-back days. It's been that long.
Well, and frankly, this is what's getting a lot of people concerned, that they're seeing any buy-the-dip moment really lose steam heading into the close. Does this sort of portend more weakness ahead? Today, as you've been saying, we are expecting Secretary of State Antony Blinken to meet with Russian Foreign Minister Sergei Lavrov in Geneva. The key issue to me is what can the U.S. do to either put sanctions on Russia or even just penalize them when there is this oil tie to Europe, Nord Stream 2, which does not make my eyes glaze over, this issue of the reliance that the European region has on Russia for their oil. Well, Brent crude rising to near the highest levels going back to 2014. How much does that price hinge on these talks? 10 a.m. we get Conference Board U.S. leading index for the month of December. Less interested in actually what this reading says and more about the trend that we see in the economic surprises for the United States. We've seen it really shift down. They were positive surprises for a number of months, and then over the past few weeks, you've seen increasingly they have come in disappointing. Does this increasingly mean a deceleration in the economy, or does this just hint to the Omicron bump in the road? And at 11:30 a.m., we hear from U.S. Treasury Secretary Janet Yellen. She is speaking at the virtual Davos confab. Yesterday, in a CNBC interview, she was talking about her expectations for inflation. She said she expects it throughout much of the year, 12-month changes to remain above 2%. But if we're successful in controlling the pandemic, she said, I expect inflation to diminish over the course of the year and hopefully to revert to normal levels by the end of the year, around 2%. How much does this become the mainstream? It seems like, John, based on market expectations, this is actually increasingly consensus, even as a number of investors push back and say they are just wrong and we are in a new inflationary environment.
Yeah, I think hope is the key word in everything Secretary Yellen said. They hope that is the case, and I think we all share that hope as well. Lisa, thank you. Michael Hartnett of Bank of America getting my attention this morning. January 20th, 2020, 2 years ago, the first confirmed US COVID-19 case. 2 years later, just 6% of investors see COVID as the biggest tail risk in the next 12 months in their Bank of America Fund Manager survey. The end of the pandemic, they say, equals the end of excess returns, equals the end of excess asset returns, and the end of excess stimulus as well. About as good as your lyrics this morning, TK. Bank of America saying the rate shock is just starting. It's not ending. Let's bring in Greg Bowdle, the head of equity and derivative strategy at BNP Paribas. Greg, we're trying to figure out a correction you run away from and one that you buy. What's the difference?
Good morning. I really think it's about the persistence of the drivers. So what we've seen at the start of this year is two forces act on equities. One is a little bit of disappointment in some of the early reporting. We've heard about Netflix. The outlook from some of the banks was soggy. And the second thing is the rate of the pace of change in real yields. If those two things carry on the way they are, it's problematic for equities. We're more bullish through the back end of the year because we think they won't.
Could that shift quicker? What I'm fascinated by, Greg, is it seems like we're compressing 4 months of zeitgeist into 3 weeks. I get the year-end call, inflation ebbs, things happen. Equities do better in August. Equities do better in October. Could we be missing that equities do better in March or April?
Absolutely. But one of the things I would point you to are the previous Fed hiking cycles. So we're all concerned about what this liftoff from the Fed is going to mean. I think the best thing to do is look what happened in previous cycles. In 12 out of 12 of the last 4 Fed hiking cycles, the market finished higher 12 months after the first Fed rate hike. Multiples compress as the Fed progresses on a rate hiking cycles, but typically equities also go up because earnings pick up the slack. However, in 4 out of 4 of the last hiking cycles, we've also seen equities lower immediately after the first Fed rate hike. So this period of indigestion we're having, this step higher in real yields, I don't think is that atypical for Fed liftoff and the first Fed hike of the cycle. So going into March, I think there's more reasons to be a little bit concerned about turbulence, but I think the outlook for the balance of the year is a bit more constructive.
Greg, heading out of bank earnings, which we got this week, how concerned are you about margin compression and, frankly, wage increases being beyond what many people expected?
If we extrapolate the banks out to the rest of reporting season, then I think it would challenge my more bullish thesis for the year ahead. The bank earnings weren't great. But this is something that we did flag going into this earnings season, that when you look ahead to the consensus earnings growth for 2022, the US sector that had the worst forecast earnings growth for 2022 was the financials. Now, the financials had an exceptional year last year. There was some unrepeatable gains in terms of things like some of the investment banking or markets revenues. So I think the banks is potentially a bad bellwether for the rest of the market this year. Obviously, people will be focused on large cap tech as they always are, but we keep keeping a close eye on some of the industrial cyclicals and the energy names. Those are 2 of the sectors for the S&P that have some of the highest forecast earnings growth for 2022.
Hey, Greg, awesome. As always, Greg Battle there of BNP Paribas. Thank you, sir. With equity futures on the NASDAQ down 93, we're down 0.6%. Lisa, really interesting piece from the team here at Bloomberg News on the financials. If you're hiring this year and boosting compensation aggressively, your stock is lower. If you're firing and if you're reducing headcount, your stock is higher. So the banks as a sector, within the banks, beneath the surface of the index level, it tells you something very, very interesting when you look at the hiring, the headcount going up, and the firing, the headcount going down.
Although the sort of footprints of those profiles are very different, right? Because the ones that are firing tend to be the big, more traditional lending banks. And I'm thinking, for example, of the Wells Fargos of the world, or even the Bank of America is sort of trying to streamline some of their services, whereas the investment bankers are the ones that are really beefing up their teams in order to capture some of the capital markets activity. It just sort of points to this real bifurcated nature in the banking world, much like, frankly, the tech world.
And the show in many ways too. JP Morgan is down 7%, almost 7% year to date so far. Wells Fargo is up almost 15% year to date so far. Just something to think about. We can talk about it a little bit later. Tom, you keep talking about the most important inflation print of the year. You keep leaning towards March. It's May 11th. It's the April inflation report. I think it's going to be really, really interesting for a lot of people. Q1 after Q1, we see that peak in inflation for many people. Then the base effects start to kick in a different way to the way they kicked in 12 months ago. Is it going to start to fade and fade materially? That could set the tone for the outlook for rate hikes after the first quarter.
Let's tell a guest coming up later this morning, Sabata Rajappa with us, yes, but George Saravelis, I thought, John, with a blistering note this morning from Deutsche Bank, which really can humble those looking for 4, 5, 6 rate increases. He says this inflation is contractionary.
He also says if you want to know where neutral is, the equity market's going to settle that debate. Let the stock market, let financial conditions tell you.
We're supposed to be in Davos.
We are. And do you know what, Tom? I'm really thankful we're not. I'm really happy we're not.
I talked to Barry. Barry said no virtual piano bar. I said, okay.
Well, I'm sure he's upset.
You should hear Barry play Meatloaf.
TK,
oh, God, Barry could play the meat like nobody.
These are high-class problems. I have to say, if it happens this summer, I'm going to be lobbying hard for it to stay in the summer. I don't want it in the winter. Futures down 103 on the NASDAQ. We roll over again. Unreal stuff. We're down 0.7%. Coming up on this bond market a little bit later of SocGen, Subsidies Rajappa. Looking forward to that from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. It's a showdown in Geneva today. U.S. Secretary of State Antony Blinken is meeting with his Russian counterpart amid rising tensions over Ukraine. Sergei Lavrov told Blinken he expects to receive a response to its demands for security in Eastern Europe. President Biden has warned Russia that it would pay a, quote, heavy price for any intervention in Ukraine. There are roughly 100,000 Russian troops near the country's border. Investors are bracing for the prospect that Netflix is now entering a new phase of slower growth. Shares of the streaming giant fell as much as 20% after its forecast for new customers disappointed. Netflix also said the slowdown will continue for at least another quarter. So here in the UK, consumer confidence fell this month to depths last seen during the early months of last year's lockdown. The inflation crisis has taken over from the pandemic as a real prime concern. There was a big drop in the index that measures whether it is a good time to buy big ticket items. That suggests people are ready to tighten their belts. And the rock superstar known as Meat Loaf has died. His late 70s album Bat Out of Hell had hit songs such as Paradise by the Dashboard Light and 2 out of 3 Ain't Bad. It became one of the best-selling albums in history with more than 40 million copies sold. Meat Loaf was 74 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company, and we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around actually, and we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Bloomberg is fastest with the numbers and analysis.
I'm going right to return on tangible equity.
They missed on FIC trading. They're too hot. Bloomberg, the fastest numbers and analysis you trust.
If any assembled Russian units move across the Ukrainian border, that is an invasion. But it will be met with severe and coordinated economic response that I've discussed in detail with our allies, as well as laid out very clearly for President Putin. But there is no doubt, let there be no doubt at all, that if Putin makes this choice, Russia will pay a heavy price.
The President of the United States straightening things out. From New York City this morning, good morning. Tom Keene, Elisa Abramovich and Jonathan Ferro. Futures down 16 on the S&P. We're down 1/3%. And once again on the NASDAQ, we're down 0.7%. But this time yields aren't higher. They are lower. And we can discuss that later. We're down a basis point on 10 to break of 180 to 179. Stock of the morning in the pre-market, there is only one. It's Netflix. It's down and down hard. It's off by almost 20%. Tom, I have a problem with this. $200 billion name should not move this much. It should not move this much. There should be better transparency about what's going on in the business. For the analyst community to be projecting something like 6 million, for the company to come in at something like 2. I know it's not rare for Netflix, but it's a $200 billion name, for goodness sake.
Yeah, I got to be careful, John. I'm going to get myself in the timeout chair. This is just arrogance. It permeates the tech people. They never want to admit there's never any guidance. The sell side gets hit over the head. It gets hit blind. That's what happened.
It's bizarre. It's a big gap lower. You've got to go back all the way to 2012 to see a move bigger than this for Netflix, bigger than 20% to be precise, all the way back to 2012 after earnings. So here we are. We're down hard, Tom, just north of 400.
Let's turn our attention to President Biden as he resets for year 2. Anne-Marie Horton is in Washington, and we'll talk about the great reset of the president in a moment. But joining us from Geneva on a perfect winter's day, and truly like from St. Pierre Cathedral, looking across at the beautiful city on the Fairmont Hotel, Maria Tadeo joins us with Mont Blanc in the background and the rest of it. Tough life, Maria. Maria, it is serious talks in Geneva. What has been the surprise for you?
Well, look, to me, what's been very surprising here is that the Russians have a very different perception of what's happening here in the West, particularly in Europe today. We're saying we could potentially go to war in Ukraine. The Russians see it very differently. You know, the great thing about being on the field is that you pick up a lot of details and anecdotes, and every Russian official, but also members of the Russian press, which are very connected to the government, they've told me we don't actually see a war happening. This is the West back again, creating drama. They don't get Russian, they don't get Vladimir Putin. So the perception here is very, very different to the tone that we hear from both the U.S. but also European countries.
The perception, Maria, is different than Clinton-Gorbachev. I think so many of our listeners and viewers are grappling with the new Russia, the Putin Russia. How is Putin-Biden different from Clinton-Gorbachev?
Well, I think, you know, here's the thing. When it comes to Ukraine, there's many ways you could look at this. President Biden says, you know, we're going to get all the sanctions that are really going to affect the Russian economy, and it's going to affect the Russian country. What Vladimir Putin is thinking right now is that they're not going to do it, and NATO's not going to do it, and the Europeans, by the way, they're not going to do anything. So this is a moment of tension that he can make a benefit on. And then the second thing, of course, is that he is looking at the energy situation. You know, the United States, a very different story, much more energy independent. But here in Europe, this is the final years in which he can really milk the Europeans on the gas, and he's going to go for that.
So in the meantime, Anne-Marie, what is the heavy price that Russia could face should they invade Ukraine, as per the United States' President Biden?
Well, Russia's already under sanctions from their 2014 annexation. This would just be a continuation of much harsher sanctions. So there's a number of issues that are being discussed with Western partners and the United States, but we're looking at export controls. Specifically, some of that is very key information in the technology information space. Sanctions on individuals, sanctions on banks, potentially cutting off Russia from dollar-denominated trades, and then a potential nuclear option would be cutting Russia off from the SWIFT payment system. And that would create havoc for Russian businesses and also Western businesses, we should note.
Brian Deese, the chief economic advisor to President Biden yesterday in response to what the U.S. could actually do to make more oil supplies available to European allies, talked about possibly other nations and getting some of those reserves unleashed. Do you know any details, Anne-Marie, on that front? Have there been discussions that you are aware of on that level?
Listen, I'm sure the administration is obviously looking into what would happen if Russia was to invade Ukraine. There was this avalanche of sanctions, and then that cuts Europe off, particularly less so oil, but more so natural gas. Europe gets more than 40% of their natural gas from from Russia. Where else can they get it from? You have the North Sea, which are being depleted. They get some from Algeria, some from Norway. Potentially, the United States could send more liquefied natural gas. I mean, do you remember in 2019, the U.S. Energy Department came out with, we're going to have freedom gas. That could potentially be one strategic play. Also, massive player in natural gas would be Qatar. The issue is, this is going to be much more expensive from the Europeans. Russia offers quick and cheap, easy gas.
Maria Tadeo, what is so important to me is the idea of the allies, the past of NATO, the future of NATO as well. The zeitgeist in Washington this morning is wrapped around the phrase fully coordinated. How fully coordinated is President Biden with the new leadership of Germany and Macron running for his new, next office?
Well, you know, two things. To me, it's very telling that Antony Blinken had to go to Berlin yesterday to make sure that everyone was speaking with one voice and the same voice. That is very telling. It's also very telling that we understand that Olaf Scholz was supposed to go to the United States and decided not to go at this point. How united they are, I think that's a big question that they're going to have to answer for themselves. And I think also another thing that's becoming very clear is that Europe is a big power when it comes to trade and when it comes to commercial interests, but when it comes to security, this is a baby. It's very early days, and still you can see there's a lot of teething problems.
Maria Tadeo, alongside the beautiful Lake Geneva, and Bloomberg's Anne-Marie Hordern down in Washington, D.C. To you both, thank you. Thank you very much. TK, an important meeting a little bit later.
Well, it's going to be an important meeting a little bit later, but far more, John. It's folding into confidence out there, and we see it in the, you know, the tea leaves, the litmus paper of the financial markets. I'm going to look at Euro Swissy, John, coming in at 103.424. Is strong Swiss franc showing the tension in the markets to the mid-afternoon in Europe.
I'm going to avoid coming up with neat narratives about the path forward in markets off the back of some of this. I was thinking back to 2014, Lisa, and Crimea, and everything that happened there. Later that year, in November of 2014, the Saudis started a war over market share in the oil market. Crude went from the 90s all the way down to the 40s. The Swiss National Bank then had to deal with a collapsing ruble, money going into the Swissy. They had to go to negative rates. The Euro-Swiss floor went a month later. Things can play out in really, really unpredictable ways when things like this happen.
That's exactly where my mind went. Dan Tannenbaum talking about clients thinking about removing their funds from Russia to get ahead of potential sanctions and potential conflict.
Sarah House is going to be joining us shortly from Wells Fargo. From New York City this morning with futures down and down hard. We're down 0.9% on the NASDAQ. This is Bloomberg.
you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The words of Bank of America: the end of the pandemic, the end of excess stimulus, the end of excess returns. Their words. Futures this morning down another 0.4 on the S&P. On the Nasdaq 100 down 122. We're down 0.8%, and we are down 10% from the previous highs. We're down about that much year to date so far. Ugly. Speaking of ugly, and speaking of the end of excess returns, switch to the board and get to these two names. It has been brutal. For Peloton, down more than 20% yesterday in the pre-market this morning. The smallest have bounced back to 25.52, up a little more than 5%. For Netflix, a $200 billion plus company, down more than 20% in the pre-market. The street looking for 6 million plus projection for subs going out. Looking forward, the forward look from the company, about a third of that. Not very good. In the bond market, well, this has nothing to do with the bond market at the moment, because yesterday yields were lower 6 basis points, and again this morning we're lower 2 basis points to 178.65. So Tom, we've gone from the dog wagging the tail to the tail wagging the dog.
Yeah, I totally take your point, John, but I would also notice, and everyone knows I'm watching the vanilla spread. Lisa knows it's not pistachio, it's a 210 spread. She's looking at things more odd. And John, it comes in 78 basis points into 76 basis points, and that's a flatter yield curve.
Can we take the Bramo, Cam, just quickly?
Really?
Just so people can appreciate how Lisa took that comment from Tom King. We can't take the Bramo,
Look, I welcome
Cam.
my odd things that I look at. I am going to defend them to my death.
The fives.
Yeah, the 5s, 30s,
the 10s,
20s, 10, 30s, sure. Can we move on?
Of course we can.
Thanks,
Belly of the yield curve.
Oh, boy.
10s at 178, Tom. 30s at 2.1%. Back to you.
Oh, you're done. Okay, thank you. There's a lot going on, seriously, on the tape as we read into the weekend and try to listen to people with perspective on the market. There is a lot going on the tape. Stay with us through the morning. George.